एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Upon C.A. Sridhar sir to please present the memento to our today's speaker. All right, thank you, sir. With this brief introduction, I would like to hand over this session to C.A. Krishnan, sir. Thank you. Over to you.
Shri Gurubhyo Namaha. Good morning to everybody. First of all, I would like to thank the Auditing and Assurance Standard Board. They have conceptualized this particular program on auditing standards, and they're having this a case study approach where they have prepared presentations on the various auditing standards topics which would be useful for all the members. I think this is the first time we are having a physical session on this particular case study approach. Of course, we have been having a lot of topics on auditing standards itself. AASB is also having this refresher course over a period of 5-6 days and virtual format also. If you go to the website, you will be able to see that. They are covering this over a period of 6 to 7 working days for about 2 to 3 hours per day is something that they are doing that. You may like to enroll for that also separately, or some of your colleagues and friends also can be joining that particular as well. And I also like to thank SIRC for hosting this particular program for over 2 days. The entire SIRC team is here. Thank you so much. And also, I understand Sri Priya Kumar, who is the chairperson of AASB, she may be coming after some time, and we'll also like to hear from her perspectives also. And the entire team of AASB has been doing a good job in terms of the required movements and the auditing standards, dealing with other stakeholders, international stakeholders also. So with this, let me take up the topic of the day, auditing standards. What I have been assigned is some standards from SA 200, the beginning standards, till SA 265. This basically your standards on the basic standards and objectives of the audit, documentation, all those aspects. As you all know, there are different sets of standards, and different speakers are going to cover all these. And there's also an announcement that people in the first 4 rows will get double CPE today. So that is also there. So you can also come in front. And I should also thank you all for coming today. Today, 12th December in Chennai, I don't know how to say what date it is. There's a big re-release happening today. But despite all that, people have come to listen to auditing standards instead of going to the re-release of a movie today, being the superstar's birthday. But thank you all. I think that means we have a very interested audience today over here. So let's keep this little more interactive. So what are auditing standards? Can somebody define what is auditing standard? Any of you can say what is basically the auditing standards? We are all practicing chartered accountants. Anybody from the industry here? Okay, we are all practicing chartered accountants. So auditing standards are basically what the process, the methodology, the audit steps that we do. Why do we do these steps? What is the reason that we are doing all these audit steps? Is it towards some particular objective? So we need to do something, so we are doing these audit steps. So what is the particular objective, and also why we are having standards? Standardization is something that we need to really introspect and do that. So I am not getting into too much of the technical part and all those things, but at the same time, it is very important that all of us know the theory of auditing standards. We are all experienced auditors. We have got a lot of exposure in different scenarios, different companies, different industries. Having said all those things, these standards have been developed much more by people who have experienced much more than us and brought it into a codified form. It is very important that we go through that at least once in a way. I am not sure how many people have read all the auditing standards in a deep way. I can see many people shaking like this. I hope they are all from Turkey, where it means yes. Turkey, it means yes. This means no. So let us see, because this is very important to read the theory, because when you are going to practically apply, unless we know the theory, what we think is the right thing may not be the right thing. For example, how many of us know that when we send confirmation of balances, there are two types of confirmation of balances? Positive and negative. So, positive means you want an answer, yes or no. Are you a MSME? You must tell me yes or you must tell me no. If I say, I am sending a thing that if you are an MSME, you tell me yes. If you keep quiet, I will assume that you are no. That is a negative confirmation. How many of us know that when we send confirmation of balances for certain areas where we have assessed them as higher risks, you cannot use negative thing. You cannot use negative then. Are we aware of this? It is there somewhere in the standard. Some of us are aware, some may not be aware. I wasn't aware till about 6 months back, though despite having 20 years of experience, I would say. So we have to go into the nitty-gritties of the standards and look into that and look into this. So why are auditing standards required also? So let us compare our auditing profession to the medical profession. So you go to a large hospital, you have some issue, you go to a large hospital, or you go to some local hospital, or you go to a local health center. What do you expect? What do you expect as a minimum? Sorry, sir? Qualitative thing. So whatever the standard the medical profession has to do, supposing they are going to give you an injection, minimum you expect that it is a new needle, the new syringe, it is opened in front of you. They take and they sanitize the area, whatever it is, or put a bandage, whatever it is. If you do not see it in a small hospital, are you okay with it? We are not okay with it, right? Similarly, as an auditor, whether we are small practice, micro practice, medium practice, 2-3 partners, sole proprietor, we need to look at the auditing standards in some way or other. It could be, the practical approach could be different, but we need to ensure that the basic minimum aspects are taken care of in these. So the next 2 days will be basically, I will say, meditating on these auditing standards, so to say, running through that, discussing these things, so that we are in a better position to, in our thought process, to say, okay, these are the things that we need to do, so that when we move forward from January, we have 3 months to the year end, we start planning process and all those things. We are in a better position to elevate our audit quality also. So that seems to be the objective of this 2-day session which is there. Another important thing is that these auditing standards, if they are followed properly, diligently, and also documented, because one is you actually follow the auditing standard, action point and documentation. If you do only action, good. You don't document, it's fine, no problem. You at least in your conscience you've done the good audit and all those things. Tomorrow when the quality reviewer comes, you will not be able to substantiate. Then you will have a problem. But the audit has been done properly. Other way around, you have not done the audit, put a documentation alone, that is called something different. That nobody does that also. But the twin aspects of doing the audit in a reasonable, good manner, qualitative manner, and documenting the same also would help us as a first and safety line of defense against any reviews that are happening. I'm not getting into NFRA or QRB or FRRB and all. Today, many of us are covered by peer review also. And peer reviewers are also going through a training process. They also go through the findings in QRB, NFRA and all those things. And they will definitely apply some of that when they come and review our practice aspects also. So that is something that we need to keep in mind, because many times when we get feedback, we say we are a small practitioner, I have only a small private limited company. So in those cases, will it apply or not? It is left to your judgment. But I would say it does apply to every assurance engagement. If you follow this, we are fortified ourselves against risks from any stakeholder, including the client himself. So that is something that we need to look into. Now, are auditing standards required for all audits, assurance audits? Supposing you are doing a small private limited company, is it required? So you have your Companies Act now, 2013, which has statutorily brought in that auditing standards have to be necessarily followed, and that is also stated in our audit report. So it is again one more reason why we need to ensure that auditing standards are really looked into and taken care of. And all. So before we get into auditing standards per se, what is the overall aspect, the framework or the ecosystem that is there? So you have something called Standards on Quality Control, SQC, which is there at both the firm level and at the engagement level also. We can say you set it at the firm level. So you basically policies. Let us take an example of this particular session. The session should start on time. We started on time. The speaker has to come there. Memento has to be ready. Somebody has to be identified to give the memento. These are all different processes which are there. It's happening now. But this is happening because there is a process laid down by the institute. This is the way in which it has to be done. So that is the SQC, quality control. And for this engagement, specific quality control process is also happening. Very similar to that in our auditing engagements also. As a firm, we need to have overall entity level processes and controls. That is called SQC, which is now going to become SQM1 and SQM2. SQM1 is the basic SQC is metamorphosed to SQM1 with some enhancements. SQM2 is the quality reviewer. Another partner going through that as a safety net is brought into SQM2 separately and with more expansion on the roles and responsibilities and things like that. So to that extent, the type of quality aspects are being emphasized by the institute. Then you have all the auditing standards which are there. You started from the objectives of the audit, documentation, communication to those charged with governance, all those aspects are there. Then you have the standards from your engagement letter to your management representation letter. What are the activities that needs to be done, confirmation of balance, blah, 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 all those things. You have set of standards on your audit reporting and things like that. You also have standards on review engagements, 240010, whether you are a statutory auditor or not a statutory auditor, that aspect is there. You also have standards on assurance engagements, a different family of thing. Standards on related services is also there. You have general clarifications, and you also have the guidance note on certificates, which is very, very important, because those certificates, many of us use the certificates, we issue a lot of certificates. So we may do 1 or 2 audits or 10 audits, 12 audits, but certificates will happen more often. So those standards are very important, and the risk is very high in the certificates area also. So that is something that we need to keep in mind. Now these guidance notes, do they have authoritative thing? Guidance note, standards appendices, guidance notes. So, is it okay if you don't follow the guidance note? It is preferable, right? But it's not mandatory. So again, initially the accounting standards itself, I'm saying, not auditing standards, accounting standard itself, initial days, it was not made mandatory for the entities. So people say, why should I follow and all those things? It was mandatory for the chartered accountants because members of the institute. Later on it was made mandatory for the entities through the statutes, companies law and all those things. Very similarly, in guidance note, what is happening today is, the institute has come out with a clarification that if the guidance notes are not followed properly, the auditor may reflect that in the audit report. I think they use the word shall or something. We have to see the exact clarification. So, the guidance notes have equal power as far as we are concerned. So, if somebody, for example, this came up in a lot big way when this non-corporate entities financial statements format was given in guidance note and all. I think some of it has been pushed by one more year also. But before that, many people had a lot of thing with the entities, talking to them about the requirement of the format and everything. There was a lot of pushback from the clients. Why should I follow, sir? After all, it's only a guidance note. It's not required. In that scenario, fine, you don't have to follow. The accounts are yours. The 2-page audit report is mine. I will say what I need to say in the audit report. And when the institute says that if the guidance note is not followed, please remark about it in your audit report. And as a member of the institute, if you do not do it, we will have a implication when there is any quality review or something. So that is something that we need to tell them and indirectly make them come and follow the guidance notes and other aspects. So apart from that, there are a lot of implementation guidance aspects and all those things which are there in the institute. And as I mentioned even in an earlier session, CAQ, Center of Audit Quality. If anybody has not gone to that particular website, ICAI CAQ, just Google that, Center of Audit Quality. It's a very, very good site because there is also this international thing on Center of Audit Quality. This only helps the auditors, chartered accountants to a lot of leverage. Tools are given to you to do the audit in a smoother manner. So CAQ has come up with a lot of publications, lot of tools like materiality calculation, Excel sheet and all those things. That is something that you can also definitely utilize. Of course, from the compliance environment for the auditors, as you are all aware, you have NFRA in one side, you have QRB, both are complementary. Whatever is covered by NFRA will not be touched by QRB and vice versa. So NFRA is looking more into public interest entities. So also you have FRRB and peer review. The difference between all these things, FRRB is something where both the auditor and the auditee will not know that the review is happening. The institute will just pull out the annual report of a company. It is done based on some process of selection, some criteria are there. Sometimes there is some media report or something that also gets triggered. So they will pull out the annual report. A set of reviewers will review the annual report without going to the auditor's office or without going to the company also. And normally they never go to the companies. So they will go through see whether there are any disclosure issues, anything there, and bring out a FRRB report. So institute has brought out 6 FRRB reports, I think, 3 in the old accounting standard, 3 in Ind AS also. Very nice publications. It's available on the institute website, where you can see 2 columns, what the particular thing has happened and what's the right way of doing things. So these 6 FRRB books are available in PDF forms. If we go through that, it will be a huge quality enhancement in how we think we should disclose things in the financial statements, approach certain aspects, report on certain things in the main audit report, CARO and other aspects also. FRRB is definitely very, very useful. FRRB is again very limited because people just take the annual report, sit somewhere. They don't look at your working papers and all those things. So it is very, very limited in scope. But there itself so many suggestions are being given by the reviewers also. Of course, you have the peer review and other aspects, and sometimes regulators also have other reviews. To safeguard ourselves in all these things, auditing standards have to be taken care of carefully also. So with this, I will move on to some of the auditing standards that I have been assigned today, starting from SA 200, which is basically the overall objectives of the independent auditor and how the conduct of the audit with the standards on auditing. That is something that has been given to me as a brief. You can take SA 200, the first one. So basically, overview has been given here in terms of the pre-read of the auditing standard. What is the context? Some case studies have been given, and but before we go into that, let me also touch upon certain things again over here. So basically, some of you would have heard that there is a proposal in MCA to do away with audits for entities which having turnover of less than 1 crore. What is your take on that? Would that affect the entities? It will definitely affect the auditors. But would it affect the entities?
If you go to cross 1 crore, at that time it's a problem.
When they cross 1 crore, it is a problem. Why is it a problem, sir?
Obviously, it's even the opening balance or whatever, it's not properly audited.
Closing balance, opening balance will be there. The problem is, you see that you may find there's a risk that the financials may have a problem, may not be stated correctly, is what you are envisaging. Okay, okay. So basically, from audit perspective, we are saying this, but this should come from the general public, saying that the audit enhances the or gives the confidence in the financial statement. It's a stamp of approval or something that's being given. If that is something which is being looked into by us, we should keep that in mind, the very basics of the audit. Why are we doing the audit? By doing the audit, we are giving a quality stamp to the financial statements. If we have that in mind, that is the major objective, which is what SA 200 talks about. And how do you do that? You do it by giving your audit opinion. So that means the audit opinion itself should be free of misstatement. Many times we find that the audit reports miss out certain things, like this audit trail came. Many companies, that is not mentioned by some auditors, they were not aware of it, other aspects. So awareness, all these aspects is something which is very important. So before we issue an audit report or audit opinion is being given, we have to ensure that we are performing the audit as per the auditing standards. That is one aspect which is there. That is what is talked about in SA 200. And also meet the ethical requirements. That is fundamental and paramount, meeting the ethical requirements of a particular audit also. Of course, the auditing standards apply to us. It doesn't apply to the management or those charged with governance and all those things. So you have these two terms, management, those charged with governance. So, and the auditor is there on one side. Many times we think that the client and the auditor, it's a two-way aspect. No, it's a three-way thing. In the entity, it could be a small entity where there could be a technical person. You can take a small proprietorship which has started, or a 2-3 part family owned thing. Second generation is coming in. Sometimes the second generation may not be technically there, but they would have had a manager, or you can call CEO, operating manager, who has been there for so many years. So they almost look at him as a family, or he takes care of the operations or the entire thing. So in that case, the management is divested or different from the owners. The owners may be called those charged with governance. In a company scenario, you have the management will be starting from the departmental heads, CEO. He may not be sitting on the board of directors or something. You may have whole-time directors. So whole-time directors are the head of the management, but they also sit in the board of directors. Audit committee, board of directors also they are there. Normally they don't sit in the audit committee meetings. They come that only to answer basically, I would say. So they are answerable to the board. So you have TCWG, those charged with governance, you have the management, and we have the auditors. So it's a three-way match, something that we need to keep in mind also, because many auditing standards talk about management in some places, talked about TCWG in some places, and in many cases they are not interchangeable. So that is something that we need to keep in mind also. But management and TCWG also have some responsibilities, and that is also talked about in SA 200. SA 200, the overall objectives of the independent auditor, that also talks. So what are they talking about? What are the responsibilities of the management, which we can take it as some basic premises. So compliance to accounting standards, they have to be ethical, those aspects. They have to select the correct accounting policies as per the standard. They can't say, this is my accounting policy, I am going to do this on LIFO basis. I have disclosed everything, so it is okay. No. It has to be as per the standard, and they have to select the correct accounting policy and have a disclosure and all those things. Judgments and estimates. So management may make certain judgments, certain estimates and all those things. So estimates, lot of estimates are there. You're starting from basic things like useful life. Your Schedule 2 companies that gives the thing. If income tax it is different, but in the normal books of accounts, lot of estimates are made on the useful life of a particular asset. The residual value is being estimated. For inventory, the NRV is estimated. For slow moving, non-moving inventory, you estimate the marketability or saleability of the product. So like that, lot of estimates are made by the management, where you may not have a specific concrete audit evidence. It could be persuasive or based on judgments and estimates. So that is again responsibility of the management to ensure that they do the correct way, in a proper way. Maintenance of the accounting records is the bedrock. We have to do it properly. Safeguarding of assets is again very important. It comes under their overall control, internal control and other aspects. Preventing and detecting fraud and irregularities is also their fundamental thing. And seeing whether the accounts are on going concern basis or not, fundamental accounting assumptions, and compliance to laws and regulations. These are all what they have to do fundamentally. Of course, for all these things, we have auditing standards also, because they have to do it correctly, and we have to ensure that it is being done correctly also. So these things have to be done. Now, when we come to our audit report, how do we communicate our audit report? There are 2 or 3 types of assurance that we can give. Leave the audit report, even certificates or something like that, let us say. There are 3 types of assurances that you can give. One is a complete assurance, true and correct. Then there is also what you call about complete assurance. Other assurance is absolute assurance, sorry. Complete assurance is absolute assurance, that is the word I was searching for. You have something called reasonable assurance, and you also have something called limited assurance. So our audit report, does it give A, absolute, B, reasonable, or C, limited assurance? Who says it gives limited assurance? What about absolute assurance? Do we give absolute assurance? So we take the mid path, reasonable assurance. So what is reasonable assurance? So what is absolute assurance? Yeah, what are we assuring? We are assuring that the financial statements are free from misstatement, right? That is what we are assuring. Now, take a case where I have to say, this particular person, Radha Krishnan, comes to office every day on time or not on time, or we are looking at that aspect. Somebody is asking me, is Radha Krishnan coming to office properly and all? I say that 100% he comes on time every day. I am giving an absolute assurance. Or I say 100% he is late. There also I give absolute assurance. The assurance is that he is coming late. That is the information I am giving. I don't think he is coming late. Late is negative. I don't think is also negative. Double negative. That is a limited assurance. I think he is coming on time, somewhere in between. But normally, when you say limited assurance, it's double negative, which is very similar to your review reports. In the review reports, you say nothing comes to our attention to believe that the matter is materially misstated. So we say that is a limited assurance. So in the respect of your reasonable assurance, you basically say there is no material misstatement. That's where we stop. No material misstatement. So when we say no material misstatement, for what? Due to fraud or error. தெரிஞ்சோ தெரியாமலையோ தெரிஞ்சு பண்ணா fraud, தெரியாம பண்ணா error. So that is the differentiation. So basically we are given an assertion that these financial statements are free from misstatement, misstatements due to fraud or error, something that we are saying that. So what is material? We have materiality in our audit approach. That is different. But what is the word material in a simple sense? Material is something that you are waiting for somebody. Sir, 5 minutes la vanduruvar. You wait. Sir, 12 minutes ahum. Sir, romba late sir, kalambren. So in your mind, the materiality is 10 minutes, beyond which you are not going to wait. So basically, materiality is something, a number, beyond which it may change the decision of the users. Here it is an economic measure that we are giving. Supposing a company has made a profit of 95 lakhs. You find an error of 35,000 rupees. It may be trivial, not very material or trivial. But you find an error of 2 lakhs. Is it material? Some people will say yes, some people will say no. So that's why the standard comes in again. So we are saying basically it is free from material statements. Whether this 2 lakhs is material or not material is something that is there. But that is where other standards are interwoven here. We'll come to that little later. And professional judgment and professional skepticism. These are the other terms used in SA 200. What is professional judgment? You go to a general physician. He says, sir, எனக்கு அந்த மாதிரி இருக்கு, கண்ணு இருக்கு, or something else saying. He comes and checks, he checks your eyes, he checks your, and then he delivers a verdict saying that you have this particular problem. Professional judgment is there, right, by the doctor. He diagnoses something to you. So basically, it is informed decision making based on what we can say cake, cumulative audit knowledge and experience. Based on the experience, the exposure that you have had, professional judgments. And also the contextual understanding, in which context it is being done. So that contextual understanding is also very important. Evidence evaluation. You evaluate the evidence. Is it evidence strong enough? Does it persuade you? Is it persuasive evidence or is it absolute evidence? How is it? Or is there anything else which is contrary to that? And also you do risk assessment in different places. And also I would say evaluating all the estimates and judgments. So these are all the professional judgments categorization that needs to be looked into. And professional skepticism is something which is very, very important for auditors. Having a questioning mind. It is not that you are getting into an investigative mind. We have to get into an investigative mind in different circumstances when there are some flags which are erupting. But generally you should have a questioning attitude. People cannot say, many times our people come and say, sir, this is what they told. I said, auditor has to hear, fine. But you have to take it in, digest it, filter it. Is that information correct or not? Some questioning attitude should be there within us. Otherwise, the fundamental of an audit is very different. So this skepticism, if it is not there at the grassroots level by the audit team members, the audit is lost then and there. So to develop the skepticism, we as leaders have to sit with our audit team, give them some examples of skepticism, arm them, and rejuvenate them every 6 months. That is very, very important. It's a fundamental aspect of the audit process. Not only having critical assessment, challenge the evidence, do some additional processes and all those things. But at the same time, every audit practically has a time limit. You cannot keep on challenging. So it also means where to stop. There should be some reasonable basis where you say, yes, now I have some persuasive thing, or I have some evidences which are sufficient for me to get a conclusion on this particular financial statements or something like that. Then this SA 200, I'm not getting into the slides because this will take only 5-10 minutes to finish. I just thought I will first talk about it. I think that's something which is very, very important. Identify and assess risk of material misstatement. So this is again SA 200, which is talks about this. You have a separate auditing standard also on that. What could be the risk of material misstatement? As we said, fraud or error. How do we do this? As an auditor, how are we doing this? We are doing this subconsciously. Each and every one of you is doing it. But if I ask you to tell me, how do you identify and assess risk of material misstatement? Many of us will not be able to articulate. Because we have not read the standard, or we have forgotten something. So, but we need to again get into that, because once we know that this is the theory, we will apply the theory in a better way when we do the audits. We are already applying it, but we will apply it in a better way. Understand the entity. Aren't we all doing it? So, first thing is understand the entity. What is the entity? Background of the entity. So, in your planning document, you have to put that. When a new audit team member is coming, what is this client? Not only the client, industry, all those things we give that. So, understanding the entity is very important. And the industry, suddenly this industry is facing this risk, all those things are very important. We are doing that also. This is talked about in SA 200. Understanding the environment. Environment is again external environment, the industry, and internal environment of that particular specific client also. That is important. The environment could be that the CFO has just left, then we have to be alert. What could be the repercussions in our, ultimately we are not looking into the profit or sales or something. For us, true and for you, risk of material misstatement due to fraud or error, with that our audit opinion, narrow approach, that's all. Other things are all tertiary, value add only for us. So for that, what will happen? Environment. And most importantly, entity's internal control. Do we have an understanding of that? So as an auditor, don't you understand your entity? Back of the hand, the environment will know. Internal control, to a large extent, we will have it, even though we may not. That's where the cake comes. Cumulative audit knowledge experience. You know, these are the problematic areas, this is a control thing, this is where they could be having a problem. We may know. But formally assessing it, documenting it is something that is a thing that we need to look into. So, again, this standard says assess the risk of material misstatement by all these things, entity, environment, control and all. Obtain sufficient and appropriate audit evidence. That will answer the question, are there any misstatements? If you get the audit evidence for every component of financial statements and do a conclusion, you will know whether they are misstated or not. Document that. Form an opinion based on these conclusions and give the report. Again, the report will be based on two different parameters, the financial reporting framework and the applicable laws or regulations. Can somebody give an example? Financial reporting framework. What is that? Schedule 3. Okay. I will put it in the second category, applicable laws and regulations. The financial reporting framework means basically your accounting standard, Ind AS, or your company accounting standard rules 21, with the first corporate, non-corporate. Within corporate, Ind AS are the old standard, old gap or Ind AS. This is the financial reporting framework that we look into. Sometimes we are asked to sign something, the financial reporting framework of US GAAP or something for specific consolidation purpose. It becomes special reporting. Our Companies Act says do the standard as per the requirements. Standard is either Ind AS or IGAP. That becomes a normal general purpose financial statements. Special purpose financial statements are also prepared. According to our audit is done also. So financial reporting framework is very important to identify. Now examples of so opinion also depends on applicable laws and regulations, standards says. Can you give me some examples? So applicable laws and regulations. Any examples that you can give which will affect our audit reporting? Okay. So how is our audit report categorized? How is our audit report for a company, a private limited company? How is it different from an international audit report?
Companies Act, it is based on that. It is a banking company, it's a banking applicable is different. It is a IRDA, it's an insurance company, that will be different. Yeah, the particular area are going to change.
Okay. Okay. Fine. Thank you. Thank you, sir. So audit report, as you know, in your will have the opinion, basis of opinion, responsibilities of the management, auditor responsibility, all those things are there. If you take any company abroad also, all these things will be there. Correct? That will be there. Other legal requirements, we have a separate chapter in our audit report. Is that there in companies which are abroad? Why does that come? Companies Act 143(3). So 143. So other legal and regulatory requirements is nothing but the SA 200 talks about that. So that is also affecting our audit opinion or audit reporting. So we have to adhere to that. So one is financial framework tied up with your auditing standards on true and fair, which is reasonable assurance. That's all, it's over. Our standard says that only. But our Companies Act says, apart from giving your audit opinion, the audit opinion is by reasonable assurance by institute. It doesn't say what is audit opinion. Companies Act doesn't say what is audit opinion. If institute says tomorrow you give limited opinion, you have to give limited opinion. So the institute is our standard setter. NFRA now is blessing it also and taking it forward. So that is one thing. So now Companies Act says report on this, report on dividend, CARO, it's also separately. IFC reporting. Again, the Companies Act triggered IFC reporting. The manner of doing IFC reporting, again, institute says how to do it, whether you have your codified form of the guidance note or you can use COSO, any of the frameworks for internal control frameworks can be used, is something that is being said. So we need to distinguish between financial reporting framework and other laws and regulatory reporting. One more classic case is 143(1). Companies Act has, I don't know how many people remember, 143(1) has 6 items that we have to evaluate while doing a statutory audit. For example, one of them is whether any personal expenses have been incurred. When we sell any investments, is it there a loss on sale of the investment? Like that, there are 6 items are there. We have to report on that only if there is an issue. Otherwise, we keep quiet. 143(3) F and G, that if there is a qualification, does it affect the company's operations? If there is nothing, we keep quiet. So wherever we keep quiet, Maunam Samadam, we keep quiet. There also, we need to evaluate. We have to put those 6 questions of 143(1), apply our audit procedures, get audit evidence, sufficient and appropriate audit evidence, conclude, document the conclusion. Somebody reviews this and document the review also and say nothing is problem, silent. So if I come and do a peer review of any of your company's audit, even if it's a small private limited company, I'll only ask one question. 143(1) ku anna sir pannal. You will not say that it's a listed company, like any company, especially in private companies, this could be an issue. Personal expenses could be there. There could be some place income tax they would have disallowed also. So I'm giving small examples where we need to ensure that these things are taken care of. Again, in small and medium enterprises, companies, small and medium enterprises from the auditing side also we are there, fine. But the dependency on the auditors is more over there. So they think that we are a one-stop shop for everything. Maybe they are right. We are also attuned to the fact that they are right. It is not so. This is where I think we need to ensure, even if practically it may continue for another 20 years, 10 years, 20 years, fine. But we need to start having the documentation, at least for risk management for us, that there are certain responsibilities that you have to do, the management or TCWG, and these are the responsibilities that I have to do. That is very, very important to, and you document that also. Whether they understand that or not, it's fine. You can document it, explain it to them. After that, they don't understand, you at least get it in writing from them. Because there could be some places where they say there's an error. Sir, how can be an error? They will question you. Actually, you have to question them. How can there be an error? The responsibility of maintaining the control system is yours. Only thing, we should not do dual work. Conflict of interest work should not be done. That is again another thing in the SA 200. Do your work in an ethical manner. Where you have any independence issues, you should not take up. Either give away the independence issue or do this. These are the things that we need to take a call. So another aspect in this is wherever you cannot get reasonable assurance, you cannot put your opinion, we'll have to qualify or withdraw from the thing also. That is something that is there. So requirements are ethical independence, professional skepticism, judgment, your compliance with standards and all those things. With this, we'll quickly run through this. Overall objective, reasonable assurance. Management responsibility is there, professional skepticism, judgment, proper audit evidence. This is what I talked about. The same thing. Last thing, management is responsible to prepare the fair presentation of financial statement. Fair presentation means adherence to the standards and also the legal aspects also. Auditor must comply with the ethical requirements. So when we talk about ethical requirements, independence, we have to, so what are the threats for independence? There are a lot of risks which are there. Independence risks, self-advocacy risks, familiarity risks. There are 4 or 5 risks which are there. So many times that is something that when in small and medium practices, that independence aspect is sometimes we have to be very careful and not get into the situations. There are also many places where clients, if they had an issue with the auditor, they are aware of these independence issues. Tomorrow it goes through the institute, through the disciplinary committee also. Sometimes we have seen some places where the auditor is doing the audit, a related party does the accounting work, actually substance or form, all those things we don't know. But there are aspects over there. We need to take a very informed view in these places on how we take care of the independence part very, very, very carefully. We can talk about independence in a very large way. For example, your client is saying that I'm going to acquire that particular business. Can you value panna mudiyuma? If you value the business and give it to him, and at that value he is buying the business, or he's taking a slightly different value, whatever it is. After 1 year or so, there's a goodwill or something like that in the transaction. You say that the goodwill is going to be impaired or something. அப்படியே பிளேட்டை கவுத்துருவார். சார் நீங்கள் தான் சார் வேல்யூ பண்ணல. You only valued it. So what happens? Self-advocacy threat. How do we will have a constraint, right? So the valuation should not be done by us itself. So another aspect is, how many of you have transfer pricing in your clients? Okay, I can see 1 or 2 hands. So in transfer pricing, as you all know, there are 2 aspects. One is the transfer pricing study or the documentation that the client should have as part of your income tax act requirements, where the arm's length basis and all is established and they are doing a study. The study could be to defend the arm's length prices at the end of the order or the end of the year, or it could be a benchmarking exercise at the beginning also to set the price. Many companies, what they do, in June, July, do a benchmarking exercise, set right the prices, and at the end of the year, top it up with a transfer pricing study report. 3CEB is a transfer pricing certification by the auditor, independent auditor. Statutory auditor can do it also, like your tax audit, and do that. But can the same statutory auditor stroke tax auditor stroke 3CEB auditor do the transfer pricing study? We don't know. Because the study is the basis for establishing the arm's length, and based on that the pricing is done. The 3CB says, based on this, we are certifying the arm's length. So when can we do that and also certify the arm's length here is something that we need. So there could be certain situations like this where we need to be very careful. Last week when I was talking in Chengalpet, we were talking about certifications. So I gave one example of a certificate saying that in some places the auditor is asked to certify the CSR amount. So CSR is based on the last 2 years, 3 years amounts and all those things, the applicability, everything is. So in April, after you finish your accounts on 31st March, you know for the current year, based on last year's account, is CSR applicable or not, one. If it is applicable, what is the amount? That also can be calculated, because it is all based on past data, and then only 2% of the, all those aspects are taken care of. Now, 2% of the average profits and other things. Now, some companies tell the auditor, sir, we want to place this on the board for the CSR committee and all, can you just certify it and give it? Now, if the statutory auditor certifies it, tomorrow finds that amount is not right amount, it's a short amount or something, and there could be issue with MCA also, won't it have a self-advocacy threat? A small example. So these type of aspects are also touched upon in SA 200 in terms of independence and all those things. That is something that we have to take care very, very carefully. Simple example here in terms of statutory audit engagement, where the firm has also performed accounting and advisory services for a decade in accordance with SA 200 and Code of Ethics. The existence of a self-review and familiarity threats are there in a significant way. The concern is there. The professional judgment is very important. The auditor determined that the independence requirements were not met and threats to the objectivity were significant. So the question is, continues to do that? Obviously, he cannot do that. If you have stopped that, that is fine. Even there, if we are the auditor, we should say the person who has been doing the accounting should not be put as audit manager. Try to change the team also. That is something which is very important. If we look at our Code of Ethics, the revised Code of Ethics, which has come up in a draft form now, and also changed a few years back, for the taxation services, there is a lot of guidance given. Generally, what they do is, if it is a listed company or public interest companies, institute is more strict. They try to give some flexibility in non-public interest entities. For example, they are aware that some companies cannot pass the deferred tax entries and all those things. They may not have the wherewithal or understanding. So they say it is okay if the auditor does it, but they ask a different team to do it, not the audit team. But for a public interest entity, don't do it. For filing return, they say it is fine, because it is a very straight-jacketed thing. There is no judgment or anything involved. It's based on tax laws. Interpretation is there, but you can do it. But there also, auditor have to ensure that responsibilities of management, our responsibility is taken care of, but it's a different thing. So from an independence perspective, code of ethics talks about a lot of these things that we need to take care also. Confidentiality aspect. A newly recruited audit staff casually discussing, inadvertently discussed something. So confidentiality is very important. The breach of confidentiality led to a significant reputational and regulatory consequences. So I'll touch upon this confidentiality. Earlier days, when we used to do audits, files and all be there, we should say files have to be kept carefully. Even when you go for lunch, lock the room or keep the files in a locked desk. These are the things. Today, with the digital age, you have to be very, very careful. And don't talk about any client matters in lunchtime, public places, lift. Once you're talking about something in the lift, some audit issue, the corner, the MD was standing in the lift like that. So it was in Bombay. We thought, but at the end of it, he came and said, Chandrasekhar, is that problem? He knew Tamil also. So you have to be very, very careful when we talk about certain things. In the breakfast, buffet breakfast in the morning, especially going to attend a audit committee, a board meeting, the sensitive information should not get leaked out. It's very, very important. And today's thing, in terms of the undisclosed price-sensitive information and all those things, sometimes you may not be doing a listed company audit, but a subsidiary, where also sometimes access should be there. Let us safeguard ourselves. Today, our team members are doing a lot of things in the mobile and all those. They may be trading, we don't know. We can't be policing them 100%, but we should have enough policies. We should have a confidentiality policy. We can put a confidentiality policy, unsensitive price-sensitive information. Have a session telling them whether they are listening or every time in the aircraft they put the safety belt thing. Why they are doing that? Yeah, it's up to you to listen or not, but they are doing it as a policy. Have a declaration saying that I will not deal with the shares. We are not dealing with it. Our staff also should not deal with it. Have a policy on an annual basis and for specific engagements also. These are the things that will safeguard us tomorrow. If somebody is found to be dealing and all, at that time they will ask, did you have a policy? Did you tell them, sir? Did you educate them? Do you have any policy? When you apply for UK visa, they will ask, have you been jailed any time? Do you think he will give you the visa if you say yes? The thing is, if you say no, when you have actually been jailed, he will catch you with that point tomorrow. So similarly, we need to ensure on these aspects. So confidentiality aspect, I just thought I'll mention this. Auditor while verifying revenue, 11:20, 11:25 late. 5 minutes late. We'll finish this session and go for tea break. So auditor staff contended that since the same was from related party, they are genuine. The related party is not genuine. In fact, related party, it is the other way around. So this is where I said, we have to arm our staff. So you have to be all the more alert. There could be accommodation between them. You have to be careful. Take the data, find what is the price per item. When they are selling at this rate, for third party what they are selling. You must know. During our review, if you ask all these questions, we will know whether our audit staff has seen all these things. Thereby the quality of audit, our monitoring and review also will be as per the standard. Just a quick brush up. Overall objectives, we talked about reasonable assurance, opinion, ethical requirements, professional skepticism, judgment. Inherent limitations of the audit is always there. That is something that the client should be knowing, both the management and those charged with governance. That is something that you need to communicate. We will see this in TCWG communication later on. This is something that we need to do that also. We talked about these two. So that finishes the SA 200. Deliberately I spent little more time on this particular standard. It's a bedrock standard, so it needed more time. So we'll have a tea break now, come back and cover all the other 5-6 standards very quickly and run through the PowerPoint presentations also. Thank you so much. We'll break for tea. So, topic is SA 210, agreeing the terms of an engagement. So I have a question. Everybody has, when we are taken in as auditors, we get an appointment letter, right? For a company, the normal appointment letter is there in the, as per the resolution or AGM resolution and all, it has been done. Or even in other entities, they give us a letter, appointment letter or something like that. And why do we need this engagement letter? Honestly saying, is it required? Isn't it superfluous? Isn't it a waste of time, effort, paper, save the trees? What is your take on it? What is your experience on that? How many of us actually put in engagement letters? We are getting appointment letters. How many of us actually put in engagement letters? It could be an audit of a partnership firm. It could be even audit of a sole proprietorship. Thank you. So, what Sir is saying is basically it will give more clarity to the client on what exactly is the scope of the audit and things like that. I completely agree with you, sir. So, in the scope of the audit, there are certain things which are there which is called preconditions for the audit, which we need to ensure. The preconditions are 2 or 3 aspects. One is the financial framework has to be agreed. Are we going to do as per AS, Ind AS and all those things? If the company is above a certain threshold limit, satisfying Ind AS requirements, and the client says you do it as per IGAP and sign the accounts, startingly out, first ball, middle stump. So, we have to be very careful there. So, financial framework has to be taken care of, and certain premises are there. The premises which we are taken for granted has to be articulated very clearly, and the management's we should secure the management's okay for that also. That is basically access to information should be there. Unfettered access to information. Additional information if you want, if you are going to ask, they should give you. It is not just some risk off thing, but additional information also. And unrestricted access to persons. So, these things have to be mentioned in your engagement letter. That is something which is very, very important. The preconditions have to be met. And for recurring audits, engagement letter may not be fully required. See, for example, in a company's audit, you are appointed for 5 years. The first time you are appointed, you give an engagement letter, and that's sufficient. In the engagement letter, a very important paragraph is there called audit fee. That don't keep it static. The business may grow, inflation is there. So, in that paragraph say, it will be from time to time agreed in writing between the auditor and the management or whatever it is. Then, supplemental letters can happen. In the same way, especially in a statutory audit, because the scope is more or less defined, you don't have to keep changing it. One engagement letter for the entire 5 years will be sufficient. Maybe every alternate year, you draw reference to that engagement letter. So, that is something which is important for recurring assignments. If it is a new one-off assignment, definitely engagement letter is required. And sometimes, I had a situation where a particular company had a specialized business. They sold the business to another company. The company was there, shell was there. They sold the business, company was still there. So, for that business, there was very special, that particular domain specific directors were there, independent directors were there. Once the business went out, they all basically resigned. 1 or 2 other people were there, the CEO moved out and all those things. A different set of directors came into picture. Different CFO was there, all the old accounting software, everything went to the new company which bought everything. So, except the auditor, everything else was new. The name was changed, the situation, the registered office was changed, everything. At that time also, an engagement letter is important. Because what you are given, the original engagement letter is for a completely different set of people, completely different status. It was an NBFC company, or it was a housing finance company, or it was a very specialized type of company. Then it is not there, it is outside all this ambit now. Engagement letter again will be required. That is something that we need to keep in mind also. And what are the contents of the engagement letter? That is also something that we need to see. Of course, Institute has an implementation guidance which is there. If you can go to that and just say implementation guidance, you can get it. Please go through that also. In recurring audits, we must review, and we should not agree to change in terms of engagement. Once the terms are there, there should be a valid reason to change the terms of engagement. Otherwise, you may even have to see whether you have to come out of it. You go and find doing something, sir, the scope lo vanda, sir, they say. In a statutory audit, everything is open to you. But there could be other assignments where they say, okay, sir, they have asked you to give net worth certificate and also turnover certificate. Suddenly he says, the turnover certificate not required. Why is he saying turnover certificate not required? You found some issue. He is now carving it out. He'll get a turnover certificate from somebody else. But based on turnover only, net worth itself is there. So if you have got some evidence and all those things already, you have to understand whether you should agree to this terms to change in engagement. The terms are changing. Why is he changing it? Why is he scoping out something? Will it have a repercussion on the other items that you are signing off? And the evidence that you already got cannot be thrown away. It has to be utilized for the balance also. So these are all fundamental aspects that we need to keep in mind over here. And what are the contents of an engagement letter? So before we go to the engagement letter, sometimes we give a proposal to the client. Sometimes we tell the client, they say give a proposal. In the proposal stage itself, you should get the terms, all these engagement letter terms should be there. Because, I'll give you a simple example. In the engagement letter you say, what is your responsibility as a client or management, TCWG, what is our responsibility we say. The same thing is articulated in the audit report also. So in the end you are articulating it, that is what you are putting into the engagement letter. But before the engagement letter itself, in the proposal itself, you should put all those things, the terms. So basically, some paragraphs will get repeated 3 times in practical thing. While giving the proposal, we should say, the audit report will be like this, but there could be a change in audit report based on circumstances. That could be there. Objective and scope of the audit has to be given. Responsibilities have to be given. Then identification of the reporting framework should be given, supplemented by laws and regulations, as I told you also. And what is the reference to the expected form of report and a statement that there may be circumstances when the report can differ from the expected form. That can also be there. And the engagement letter also should say that we should get representation from the client later on. All those things should be there. As part of, see, it's the deal, it's the terms and conditions upfront. So everything is transparent and on the table. Tomorrow you're going to ask something, they'll say it is not there in the particular thing. So how do we do it? So we need to keep these aspects in mind. First time engagement with scope limitation. Management doesn't give you the past accounts because of confidentiality. Preconditions are not met. Auditor should not accept the engagement as access to records is essential. You'll be very tempted. Good audit, nice client. But why is he not giving earlier one? We don't know. There could be something, there could not be anything also. But the moment access is not there, they are asking you to swim with your arms tied. There is only one direction in which you can go. You will only sink. So it's better to avoid. Engagement refused due to inadequate framework situation. The acceptable financial framework is not there. They are asking you to put it in some other set of accounting policies. Again, it is not met, so we may have to. Management does not take responsibility for internal control. They say, sir, it is your problem, sir. You only have to ensure as an auditor. So there is not a meeting of minds. Then there is going to be a problem tomorrow. If there is a small issue, then we will be fighting over the issue rather than giving an opinion. So do you have to get into that situation? Most of the times, audit risk is coming because of the selection of the proper client. The type of industry, the type of practices, the type of attitude, the type of the maturity the client has, the type of professionals they have to support them, guide them. So those aspects have to be taken care of. All those things come in part of this particular thing. Any questions till now? Of course, there are different formats of engagement letter and all those things. For if you have an IFC, then there is a format. All those things are available in the institute website. Guidance note is there. The implementation guidance is there. So these are the terms of engagement. Engagement letter to be accepted and countersigned by the entity management. So who signs the engagement letter is also very important. The CFO should not sign. get it from the whole-time director, get it from the audit committee chairman. Try to get it one level more than what you normally do. That is something which is very, very important. Only then the message goes across to them. Accept and change, I already told you. If the terms are changed, then agree on the new terms and get the EL and also. The Center of Audit Quality, as I told you, they have letter formats and all those things available. So you can also take that and download the same also. Can we go to the next one? Is it possible? SA 220. Mudima sir? Okay. So SA 220 talks about quality control, audit of financial statements. That is nothing but SQC at the firm level, as I told you. The same thing at an engagement level it is there. I will take a simple example to drive home this. As I told you earlier on confidentiality, independence, what we do is every year in the month of April, the firm, we take a letter that all the people, staff have studied the independence and confidentiality document policy of the firm. They give a writing saying that we are adhering to it, we understood it, we will not go away from it. And we also give a list of publicly interested entities, listed company assignments that we do. And they say if they have a share in that particular thing or some relationship is there with somebody, they will have to spell it out in April. Every year, everybody has to do. Later on, if there is an amendment, that is also taken care of in a process. Apart from that, at every engagement, that engagement team will have to give a specific thing also. So these are two different things, annual done at the firm level and engagement specific. Similarly, quality control, SQC is a larger thing, engagement level quality control is different. I'll quickly run through that. Leadership responsibilities are there, very easy. The engagement partner takes the responsibility, the engagement manager takes the responsibilities. Relevant ethical requirements of that particular engagement. It's a statutory audit. Are we allowed to do that? Is the independence there? Have we done any? Sometimes what happens, we are appointed in July or August in the AGM. We were the earlier internal auditors. We already issued the internal audit for the first quarter. What will you do? April to June, I already issued the internal audit. For the same period, you have to do the statutory audit also. And you take it up. So you have to safeguard earlier itself, there is a plan, don't do the internal audit. Why get into this type of controversy? So like that, we will have to see. So that is important. Acceptance and continuance of client relationship, audit engagement. So there are 4 items here. Acceptance, first time, and continuance. Both have to be evaluated carefully of the client relationship itself or of a particular audit engagement. Now, a particular client comes and tells me, sir, you can give me this CSR certificate, as I told you. I said, I cannot do it, sir. It is going against my independence. I don't say no to the client. I will not be with the client. This thing I cannot do. You ask somebody else to do it, we'll do it. The client relationship continues for other work, but this thing, because of independence, we are not able to do it. The valuation is not, we are not able to do it. So that is on specific assignments for a particular client. Sometimes you may decide that the client relationship itself is not required. In a recurring thing. At the start itself, new client, you take it up. Anything, you have to evaluate the client relationship. So for that also, there are specific forms available. So I am now marrying the auditing standard with the documentation also. So you have client evaluation form, client continuation form. That forms will evaluate many things like, including commercial aspects. Are we spending too much time on the client? Is our fees sufficient to that? That is one very, very important thing. But apart from that, is the client giving you good error-free accounts? Or if you find out errors, are they taking that and rectifying it and going to the root cause and doing it? What is the attitude of the client? Are there any specific pressures for them to keep up certain things? These and all you'll have to see. Take a balanced view based on your risk appetite, what is the industry he is in, all those things, and then take a call whether you want to take this person as a client itself in the first instance. And after that, every year, decide whether you want to continue the assignment also. In this scenario, it is also important that every firm has a not only client retention policy, there is a resignation policy also. Today, resigning from the audits also is not easy. All of you will be aware that in last 6-7 years, large audits where there were risks, the audit firms thought we can resign and move away from the responsibilities. No, you cannot do that. In fact, SEBI says, if you are already the auditor up to the second quarter or third quarter, you finish the audit, then you resign. So, it is like a doctor, you can't tell the patient to come on the surgery table, then say, I will not do the surgery. Very similar. So, it's a big assignment or big audit. You cannot say last moment you can back it out. So, those types of things are there. And every resignation has certain repercussions also. It flags off in the MCA. MCA will find out why it is. There could come for a thing. So the firm should have a resignation policy. Where and all you should move out? What is the process for that? They should first, if you have a constraint or you have a concern somewhere, communicate to the client to remove the concern. If they still not do it, then internally discuss. Sometimes you have to take a legal opinion also, whether you can move out. Some places you are not allowed to move, like I told you, SEBI and all those things. They say you cannot move out. Then what type of documentation you should still communicate to the client, have a discomfort, but because the law regulation says I have to continue, I am continuing. This type of aspects and all have to be taken care of. All these things have to be done. They should have a process in the firm. This policy should also be there. That is at the SQC level. But at the engagement level also, these things you have to take care. அடுத்து 220. Assigning engagement teams. Very simple. It's a very simple thing. And we have to ensure that the proper persons are assigned to the team. For a big important audit, suppose you are doing a bank audit, you cannot just send 2 article clerks. You have to say the size of the team matters, the type of team also is important. Whether the person has the domain experience. If you don't have any domain experience, should we engage a professional from outside? All those aspects have to be taken care of. Ethical aspects, acceptance continuance. EP assign the engagement team with appropriate competence. Undertake timely consultations. Review the audit team members, what they have done. Engagement partner to provide clear direction, supervision, review of the audit work. There have been some places where the audit team is doing the work, 3 weeks, 4 weeks, no review and all. Tomorrow you have to sign 1 or 2 days before, last minute review. Sometimes it's not enough. Even if there's an issue, you don't have time to talk to the client, finish it. Then you are on the defensive side. So the process itself should be careful. So this is an operational aspect. The SQC will design of the processes. Operational effectiveness for every assignment is very important here. And engagement quality control reviewer should be there for certain companies, listed company audits and all those things. Another partner or a senior person should be doing the balancing act in terms of ensuring that the quality review is taken care of. That is now covered in a very detailed manner in SQM2, which is there. For example, in a listed company, the rotational also is there, familiarity threat. As an engagement partner, I can be there only for 7 years, then I have to step out. Another partner is a quality review partner. Now, after 7 years, both of us will have to step out. It gives a very unique situation where the audit is there for 5 years, 10 years, but at the end of the 7th year, we have to move out. So, what we should do, at least the quality review partner moves out in the 5th year, another person comes there. There's some sort of a rotation or handover process should be there. Or while you have to move out in the 7th year, bring in one more partner as an understudy so that he's familiar with the client, because clients should not have a completely different partner, completely different approach and all those things. But the whole thing is to ensure that there is no complacency or the relationship, long-term relationship should not be factored into the audit process. Those aspects are there also. In terms of the ethical aspects, as I tell, integrity, objectivity, professional competence, confidentiality and professional behavior. So these things have to be there. Independence threats, self-interest threat, where supposing the client is giving you fees of more than 50-60% of your total income, the self-interest has to retain the client. Self-review threat, as I told you on the valuation assignments. Advocacy threat. Familiarity threat, intimidation threat. These are all there. We have to ensure that we are safeguarding ourselves in all these aspects also. During the audit of GE Limited, engagement partner became that one of the firm's networked entities have recently provided tax advisory services. So, how do we do this? You have to be careful. Engagement partner documented the independence evaluation and then came to a decision. Documentation clearly demonstrated compliance with ethical requirements and supported the decision to continue the engagement. The thing is, the question is not whether you are moving away from the engagement or not. The question is whether you are evaluating whether you should move away or not, and then coming to a proper decision. During the audit, ECQR finds that a material loan agreement with a related party discussed in management meetings is not disclosed in the financial statements. Omission is corrected on time. So, ECQR is there. It is an example where in a company the quality review partner is playing. See, again the question is quality review partner. So, you have a partner, manager, team doing the audit. Quality review partner overall sees it. Now, the question is how much should the quality review partner dig in? Does he do a re-audit completely? Or he just says, okay, just skim the surface? Both are not good. So, SQM2 gives you that particular thing. So, he should ensure that it's a process done. What type of people have you put in? Oh, okay, these people know they can actually do the audit properly, they're competent people. Somebody has domain experience. Somebody is not afraid to talk back to us and give us information. So, that is one thing. So, he will evaluate various factors. He will evaluate whether have you done a planning document, have you set a materiality. So, he will do some sort of a mini peer review type of a thing at the engagement level, and that is given in the SQM document, SQM2, which is getting mandatory from 1st April 2026. SQM1 is the old SQC. So, please go through SQM1, whether you are going to have a quality review partner or not, face a hypothetical phantom partner and do your audit. It will help you to increase the quality of your audit also. Acceptance of a gift. Again, many firms have a policy. Okay, you can accept something less than 1,000 rupees or 4,000 rupees, 5,000 rupees, something will be there. There are some corporates which say that we will not accept anything. There are some firms which say that we will not take article clerks from our client companies. Because that also is a form of, you are getting on goody terms with them. So, many firms say, in many of the places, in our cases, our clients will say, sir, my accountant's son is, or my relative's friend is, son is going to do articleship, can't you take him? We take them. We don't think of this, but there is another line of thought now. The engagement partner acted appropriately by removing the team member from the engagement. Even in those cases where we get clients, relatives or somebody, we don't send them to that audit, right? That we take care. So, I am just saying, so there are certain things which are already part of our system subconsciously. The policies are something that we have to bring. Those policies are all available. The CAQ, you go to international CAQ, many such guidance is available in terms of what is the safeguard threats we have to put in also. Quality control document of the firm, that itself is available. So, these are the main thing in the audit, quality control in the audit of financial statements. It's a very fundamental thing, very simple thing, but very profound. If you don't do this, so what could go wrong? If you don't put the right type of people, you will get a wrong, there could be material misstatements, you are only at risk. If you don't have enough time for the audit, you don't plan the audit, you don't put the materiality, you don't review the work of the people, ignorance can be bliss, but at some time it can strike back also. So, quality control is very important. Key principles you are just revising. leadership responsibility, ethical requirements should be there. Independence, we have to take care of the engagement, have it documented also. Not only for the engagement partner, for each and every team member, an independence form has to be signed off. Acceptance, continuation of the engagement also for the client relationship, both are important. If you do it at the client level, after the AGM, when you say we are accepting the client, for them we are going to do statutory audit, tax audit, this, that is sufficient. So re-acceptance form has to be filled up. In our firm, we tell them after August, September, the AGMs are done. Now in October, November, December, all the forms have to be filled. Now the second fortnight of December generally slightly free before we go to the quarterly review of December. I said all those re-acceptance forms, finish it off. Ensure that the engagement letters are sent. Start doing some planning documentation. All these things now, they say that when the sea is rough, fishermen mend their nets. They say same thing we also do like that. With a slightly lesser thing, we try to finish all these things. Look at the fee evaluation, whether we have to look at the fee level for next time. That has to come in the engagement letter or as an addendum to the engagement letter. Last minute, you cannot run. If we do everything, we forget our fees. So all those aspects, right from the beginning, we have to take care. Risk management is very important. Direction, supervision by the partner is important. Reviews have to happen at timely intervals. Documentation of the review is very important. Hey, audit person who goes there, he gets the audit evidence, he ticks it, he puts a conclusion, everything. When I go and review him, where am I documenting it? That is where sometime nowadays there are portals available, workflow documents available where you can click and say I've signed off and all those things. Not everybody will use that workflow document, but I think Institute is also bringing up a simplified workflow document. I'm not talking about administrative document, GST, all those things. For audit itself, workflow document is, I think, something on the anvil or something like that. But there are many such softwares available. Notwithstanding that, we have to devise our own way of documenting our review. At least at the end of the review, today you can even put it in a Google Meet and take that note taker and keep the summary. There are ways and means. If we ensure that it has to be done, it can be done. Consultations are very important. Many times we consult. In the audit issue, okay, we talk to a friend, somewhere documented. Sometimes when we talk to another chartered accountant, he may be in a firm where they preclude him from giving a formal reply. They say, sir, now I can't mail you, but I will talk to you over phone. At least record it somewhere in your own thing. I talked to this person, he gave this. He may not tomorrow take cognizance of that, but you can at least keep something with you. Or some people say, don't send it to my office ID, send it to my, personally I can help it. It depends on their policies. But the fact is, where you have a doubt on a specific issue, consult somebody. If our firm has only one or two people, I am the senior most partner, I have only juniors, talk to another friend. Get something and keep it. Tomorrow if there is an issue, you can say that there is no negligence or gross negligence. I have taken a judgmental decision based on these things that will help you to de-risk your audit process also. So that is something which is very important in terms of consultation. Quality review, I told you, another partner comes and says that should be sensitively handled. Until any matter is not resolved, audit cannot be signed. It has to be resolved. The consulting partner, quality review partner cannot say, he cannot say that. It has to be concluded properly. If he has a difference, the difference has to be resolved. Go to the another partner or go for consultation. That process has to take place. Time has to be kept for that process also. That is the difference of opinion. And all these things you have to document. Next. Audit documentation is something which, in a peer review or anything, you finish audit file. How many of us have been subject to a peer review? So, when you give the peer reviewer comes, we ensure that we sit with him, talk to him and all. We had a quality review done. SEBI review came after this, somewhere, I think after Satyam issue, some top 50 listed companies, 100 listed companies, we were also doing one audit of some company which was listed. So another auditor came from some other location, Nagpur or some, not one Tamil Nadu or South India. He said, keep the files. So I said, we'll see this, sir, this person will be here. If you have any doubt, you can ask him. You please go. I will talk to the files. The files should talk to me. So we tried to tell him, sir, we have planned everything. We have so much of planning people. We did all these things. We went to the client. Writing. What is not documented is not there. That's why I said in the beginning, we have done the audit. Your conscience is satisfied. But you have to elevate our conscience for documentation also. Otherwise, you have a de-risking issue. That is something that we need to take a call. So you have to document your audit procedures, ensure it is done in a timely manner, results from the audit procedures, significant matters and conclusions, professional judgments have to be documented. Any information which is inconsistent, if it is there, how have you addressed that? Okay, have you set it aside for a good reason? What? If there is a departure from a standard, our FAR presentation is what is we have. We can move away from a standard if it is required. But at that time, what type of documentation we have, the basis for that also, that may have to be given an emphasis of matter, that is different. But in the working papers, are you satisfied that they have moved away for a good reason, resulting in an emphasis? They have to document. Lot of work papers have to be built up in all these cases. An experienced auditor to understand from the files. 7 years you have to retain the files. And at the end of the audit, we have some 60 days to finish the thing. At that time, you cannot do fresh audit and create fresh working papers and all. Whatever is there, you can do the housekeeping and all. Old papers can be discarded, the superseded ones and all those things you can do at that time. That is something which is very important. And see, documentation, when you talk about it, what type of documentation are you looking into? One is, you have a planning document, a strategy document. If you go to NFRA website, recently they have given strategy and planning. Strategy is, okay, I want to go to Tirupati, take the blessings. That is strategy. Planning, I'm going to book a ticket. Tomorrow morning I'm going to go. Little more integrity. So strategy, planning, our assessment of the risk of misstatement in different components of financial statements. Whether what is the inherent risk, what is the controlled risk, what is the overall risk, what is our thing for that. These type of things to be documented. So documentation is in different things. Auditing standards have to be documented. If there is a service provider, outside service provider, what have we done for that? That has to be documented. Confirmations have to be documented. So auditing standards compliances have to be done. Our conclusions have to be done. Major issues which have come, those aspects will have to be documented. So these are all the things that we are looking at in documentation aspect. This is what I told you. An experienced auditor with no prior connection to the audit should understand your documentation. The file should speak. Many times we have the data with us, our audit team members have seen it. Yeah, let us take additions of fixed assets. They would have given the addition list completely, they would have kept it. They will come and tell us, you do one thing, keep the population in one place. I'll give this example. Keep the population in one place. How did you ensure that this population is a population? Completeness. That is very important, right? So you should say that I sat in front of them, they took it out from the SAP with the parameters and pulled out the addition list. At that time, take a screenshot, ask them to send that screenshot, the parameters. So that will ensure that the proper parameters are there for completeness of the population. Then what sample you have taken, what are the basis of sampling. Then what are the parameters you have checked? For example, for additions were checked with reference to the invoices, with reference to the capital purchase orders. We took a thing that whether it is a capex or revenue judgment was done, whether the GST has been appropriately accounted, input credit, not input credit, all those aspects. What are different parameters that you are saying? We have to, in the quality control, arm our article clerk, then they have to document like this, conclude it and do that. If you just have an addition list alone, that will not talk. So these small things we have to start teaching our audit team members to enhance our documentation at the basic work paper level. Then comes the checklist. 143.1 checklist, CARO checklist, accounting standard checklist, auditing standard checklist. All those things are later. But these are the things which we have to see. And every audit report, your regulations are there. Audit trail, something you have to keep. You have to keep something for your funds management, whether any funds have come through the company to somebody else or you are given it to somebody to give it to third party. Further representation has to be received. All those aspects will have to be taken care of, documented also. In your audit report, so many things are there. Dividend compliance checklist, because you are saying dividend has been paid properly as per 123. Attributed. List of contingent liabilities, litigations you have to take and document it, because you are saying everything has been, financial impact has been taken. So everything which is there in the audit report also have to be backed up by documentation. CARO, every paper, every clause has to be backed up with the data, work done, conclusions. Those things are very, very important. Implementation guide is again there. Sir, 240 palam. Sir, SA 240. Responsibilities relating to fraud. Most important thing, fraud. Are we responsible for fraud or not? Blood down to watchdog, bow bow. Whether we are blood down or watchdog, we are supposed to be a dog. Are we supposed to bark? Is the bark worse than the bite? What is the thought process? Are we really responsible for fraud? Yes and no. Any thoughts on that? Anybody wants a mic? How many people think we are not responsible for fraud? Few of them not responsible for fraud. So all others say we are responsible for fraud. Oh my. Okay. So what did our reasonable assurance, what did we say? Reasonable assurance, there is no material misstatement due to fraud or error. So what do you do for that? So there is some amount of responsibility you are taking, you are articulating it very specifically in the audit report. Material misstatements. So this standard talks about fraud depression. This standard is there for a long time. There are evolutions happening in the standard in the international arena. Please go through that also if it is possible. You have a fraud guidance note also which is mentioned somewhere later. But that fraud guidance note is for where the fraud is found out and all those things. Plus audit approach also. Both are there. So what are the there is one case where in a particular company, morning they opened the door, they found that the window was broken into, the accounting room was broken into, the safe was open, the cash has gone. Will you report this as fraud or not? Will this be reported as fraud? Yes? It will not be reported because there is no intention to conceal. There is no concealment. So, fraud means misreporting or fraudulent financial reporting. Because there is a misreporting due to I fraudulently misreport. I jack up my sales or all those. That is one type of fraud. The other type of fraud is misreporting or misappropriation of asset. Some assets are gone, sold, but still kept in the books. That is also misreporting. So these are the two types of fraud that can happen. We are also aware fraud can happen due to internal and external stakeholders. It can happen. And our Companies Act has a separate section for that. We have reporting to the based on the 1 crore limit. Only if it is done by somebody internally, there are further reporting requirements by the auditor. There are all special considerations in the Companies Act and all those things. I'm not getting into that. I'm going to the auditing standard before Companies Act 2013 came into picture. This auditing standard is there. It says that the auditor need not make a legal determination whether it's a fraud or not. It is not our thing to determine whether it's a fraud. That sometimes it may even determine in a court. We cannot determine. responsibility and prevention and detection of fraud fundamentally lies with the TCWG and management. That needs to be first spelled out. The likelihood of detection should be high. They should have that much of processes there. If something fraud is happening, it should come out quickly. That's the process should be there. There should be deterrent factors in terms of punishment. They should also have a culture of honesty, ethical behavior. So all these things you should ask the client, do you have all those things? Do you have a policy? All those things, they should have it. Our thing is, inherent limitations to detect fraud is there, though we have a reasonable assurance, because there are sophisticated schemes to conceal, intentional misrepresentation could be there, collusion could be there, and they will say a persuasive audit evidence, not a conclusive audit evidence. They will try to give us audit evidence which is persuasive, but which is actually false. So these inherent issues are there. So the standard says that though we are given our audit procedures have to be looked into and all those things, we are fundamentally responsible for a fraud, but material misstatements due to fraud, if we follow procedures properly, most likely to detect it also. So both are being talked about, and it says that management or employee fraud is more difficult than an external fraud. That is also there. This is where professional skepticism is very, very important. The potential for management override of control should be part of the planning process. Management override of controls in our group audit instructions, if you give to others in the SA 600 or we receive it from others, this is a very fundamental thing. They will say two things are high risk. Revenue, SA 315, revenue is by default high risk. Risk that material revenue is misstated, overstated and all those things. This is also there. And management override of controls, where we have to ensure that judgments, estimates, journal entries, so these are all, we have to check that to ensure that there is no override happening. Now with audit trail also there, it is very easy to see that some of these things. Journal vouchers have to be seen and all those things. And most importantly, risk management procedures of the management and TCWG. If you are doing a slightly larger company, you have to talk about four things. Does the management assess fraud risk? You have to sit with the CFO. Sir, supposing a fraud can happen in that, what are the controls you have? If he says like this, then we have a problem. Because they are not even assessing fraud risk. From their side, they should envisage, engala fraud nadakala. And management process for identifying and responding to fraud risk also is important. They should do it, they should be prepared. Management should communicate to TCWG in the larger companies and all, how they are ready for that. Only then TCWG will get a comfort. And management communication to employees also. That is a more positive thing. We should be in an ethical way. All those things are part of the learning process, learning and development. But all these things are very, very important. The third thing is very important. Management should talk to TCWG on their preparedness for how they ensure that they have an anti-fraud environment. At least not a situation conducive to fraud. They should be talking about fraud, living and breathing fraud at some points of time. Just like we have this auditing assurance standards every December and code of ethics every December, we have this. They should also have this. They should have, somewhere they should talk about fraud, how they prevent fraud, what are the processes they have, prevention and detection. Once they talk about it, there is a highly possible situation of our environment having a lesser probability of these things being there also. So these things have to be looked into. Fraudulent financial reporting, misappropriation. As I said, skepticism is very important. Risk assessment procedures have to be done. So there are fraud risk assessment questionnaire, checklist is available. So checklist has many questions. You can just go for fraud risk assessment checklist, Google, it's available. Start using a simple form. How do they ensure that the sales are not the different things, aspects are there? How do they ensure that ghost employees are not there? What does the company do to ensure certain things? They will be having, no company will want, owner will want their money to go down the drain. So what is the thing that they have? Dialogue with them. It may be there in the subconscious. It has to be brought to the conscious and formal level. This guidance note is there, but this is dealing also with the auditing thing on fraud aspects, but also what to do once a fraud has been discovered. More things on the second part. But our auditing standard is on the first part. Intentional act, TCWG responsible. We are not responsible for preventing, but reasonable assurance is given. Skepticism should be there. I'll pause a minute, you can go through this. Is it sufficient? Basically, embezzlement was there, reinforced the segregation of duties. How many times do we see what are the type of payments which are being done, cash and bank payments? Today, earlier days it was checks. Somebody can sign on behalf of somebody, misrepresent, all those things. How many of us see whether the check signatory is, especially in small and medium enterprises, where the owners also depend on us. They should not, their responsibility, but they depend on us. Sir, நீங்க தான் எல்லாம் பார்த்தபோல நினைச்சேன் அப்படின்னு. So, in small private companies, suppose there are dual signatories, how do you ensure that? Have you seen what has been given to the bank? Is it dual signatory or single signatory? Have you seen that extract has been taken from the minutes and given? Is the minutes there in most of the companies? So, I have come across a case where the minutes was there, dual signatories, but when the person, CFO, took that, he said single signatory, director signed it off, it went to the bank as single signatory. So, extract of the minutes should be checked with the minutes, especially the thing which is going to the bank. Please put it in your audit steps. Whatever extract has been given to the bank for signatories, check it with the original minutes. If the original minutes are not there, you do your client risk assessment. You are there in the client which doesn't have the basic documents. Not a problem, everything will come out. Then they will say, sir, you solli. So, let us all assume that the fraud can happen. For a moment, somebody embezzles money. What will you do at that time? Post facto, whatever you do it now. You can sleep better. Nowadays, how much of you see that? What type of payments are given? Is it by NEFT or is it by the portal or mobile payment? Whose mobile number is given? Who gets the OTP? Have you asked the CFO, sir, are you giving all the OTP? Or he'll say, I'm sharing the OTP with that person. Or worse, he's giving the mobile receipt to that person. Or there's a common mobile number for OTP. Is all part of internal control? How many of us are questioning all those things? Please do so. Confirmation of balance from banks. It can be documentation. The confirmation should go directly from us to them. As article clerk, I put the stamp paper, put it in the post box and come. Or we go to the bank directly, got it also. Today, email, we have to send a mail to the bank with the authorization from the company, directly send the mail, get it. Today, the portals are also available. Institute is also bringing out a bank confirmation portal. Banks are joining the portal also. That can be utilized. So, that is also very, very important. Sending it directly is important, very important. Getting it directly is also equally important. And if you are getting it by post, retain the envelopes. Surprise counts revealed significant inventory discrepancies. Inventory was adjusted. Internal controls were reviewed and strengthened. But it was not a material weakness for IFC. It was a significant deficiency to be told to TCWG. Senior management, backdated sales invoices. Sometimes you have sales cut-off issue. So all those things, how you deal with it is very important. The question is, some of these hypothetical situations need to be discussed with the audit team members to give them that amount of skepticism in their audit processes. That is something which is very, very important. Also, have a discussion with the internal audit function. That is another important, the third dimension in your fraud prevention. What are they doing? What is their take on all these things? And at every component of financial statement level, identify fraud, misstatement aspects. Simple things. You can say, what if somebody has pilfered away some property, plant and equipment? In a big machine cannot be taken away. But there are enough places where PPE can be pulled out. Okay, for that, what is the control which is there? Is there a control in the company? Is there a process? Keep that. So, at every component level, it can be sometimes but don't go to that extreme. At least put some major things. For payroll, what is the thing that there could be fraudulent employees? What is the thing that fraudulent employees can be done by the HR person itself? Then you look into segregation of duties. Who brings, so is there a genuine employees coming, especially during COVID and all those things, there is an issue. So, like that, you have to think about possible situation of that frauds can happen and what processes and controls the company has, if they have it or not. If they don't have it, that itself is a point for reporting. If they don't have it, you have to increase your substantive testing. If they have it, ensure that control testing is done correctly over there and documented also. Now, this fraud evaluation itself has to be done and kept separately. Yes, sir. It is always advisable to give a police complaint.
How to account it, the loss because of this fraud?
How to account it?
Yes. Loss.
Suppose there is an embezzlement.
There is a loss, yeah.
There is an embezzlement of 53 lakhs in a particular company. We have found it before the audit. Post balance sheet, we have found it. The embezzlement is there. June, July, you have done the audit. Embezzlement has been there from last December to June. 43 lakhs before March, 10 lakhs after 31st March. In your notes and accounts, only 43 lakhs is there in your books of accounts. Make a provision for it. If the company is not going to make a provision for it, you may have to qualify it also. Because you don't have an audit evidence that it will come tomorrow. Are you very sure it will come? Police complaint is there, the person has been caught, but will the money come back? If he doesn't have the money, if he has pilfered it away for some reason, he has gone on a holiday, somewhere he has given the money will not come back. He may be punished, he may go to jail, but the money will not come. So you may have to make a provision for it. Or money has come back later, you can even put an emphasis. You should also give the post balance sheet event. That is a non-existing post balance sheet event to the extent of 10 lakhs. Because that is not there on the balance sheet date. But that also has to be disclosed properly. And your insisting of the police complaint is very important. If the management does not put a police complaint, that is a signal of why are they not complaining to the police?
Mutual adjustment.
Huh?
Mutual adjustment.
So you have to look at all those aspects. And that is where your fraud reporting kicks in. Audit committee, board and all those things. Small companies are different. You have to handle it differently. But these things, but those principles remain same. So that is something that we need to look into. The discussion among engagement team is very important in every audit. What could be the fraud types of things generally and major components. Major components. It could be a fixed assets, it could be inventory. Fraud could be misappropriation, it could be dummy type of people for taking out the money, or it could be misreporting, how they reduce the expenses. All those type of things should be taken care of. We should have at least 10 to 15 scenarios in our audit processes. You should also encourage TCWG. How are you comfortable with the anti-fraud controls? Draw them inside. Make them, the skin in the game should be there. They should also come and play the game with you. So draw them inside. So tomorrow, otherwise they will sit there and ask you why this has happened. No, bring them inside. Let us talk about fraud in one of the. There is a place where we said there is no discussion on anti-fraud controls in the last 3-4 years in the company. We made that presentation. One small point over there. That ensured that they start moving on that. Relationships, related party relationships, very important. This is what I told you. At the component level, you have to see. Here, by revenue is always by default a very high risk. Okay. These are all, there could be situations where we may have to move out also from the audit, but these are very rare situations. We have to take a call, we have to take a legal opinion wherever it is required also. Moving out of the assignment is not an easy decision also. management representation are very, very important. Not only the fraud situation, even normally, tomorrow you will discover a fraud also. Management has said that they are responsible for all these things given to you in writing. That is very, very important. It cannot be overemphasized. Ensure that the MRL is ready on the day of the audit committee meeting or board meeting or the day you are going to sign the accounts. When the accounts come to you after signing, who was signing, partner, director or something, along with that the MRL should come to you. Make that as a practice. MRL should be a live document at the beginning of the audit based on last year's MRL. Keep changing it then and there whenever required. Don't prepare it after signing the accounts. For heaven's sake, don't start preparing it after signing the accounts. It's a live document. As soon as you have an audit issue, audit query, all those things will have an effect on your MRL. Keep updating it. It's a live, it has to be done. That is very, very important. We also have to communicate TCWG at normal intervals. Your question is answered here, sir. Regulatory enforcement authorities, that also has to be taken care of. If they are not doing it, what is the reason has to be looked into. Different fraudulent reporting is there. False disclosures also are very, very important. Disclosure done is not affecting the numbers, that cannot be the thing. Okay. These are all available. If the fraud is detected, all these things. So we are more talking about the auditing standard on ensuring the audit is done as per the standard. Tomorrow we are done it in the proper due process. The next one, sir. 1,500.
This is normal rate.
Normal rate, yes.
Section of active.
Very good question. One is documentations are there, but we'll have to exercise more due caution. First of all,
We are not civil engineers, but we know some basic elements.
is there a, but the invoice is there also. Invoice is there, everything is there.
Why is that?
And payment is also done.
They have got golden cement, golden rod, everything they might have used, I think. I don't know.
Okay, okay. See, it's a related party, that is something that you need to see. You need to ask the management why the normal rate is like this. Supposing they bought cement at a far higher rate than this, why is it that they bought at a higher rate? That is something that we need to see. If you really feel that they are not giving a proper answer, you are not convinced, you may have to withdraw from the assignment. Yeah, if you are not satisfied, you cannot sign something where you are not. It's a substance over form, sir. Now you yourself said there is a problem. Form, everything is right. As a chartered accountant, you should not put your seal there. You should exit that place. Tomorrow, when some other auditor comes, when you ask for why you moved out, that is also there. Today, people say when you move out, you have to say why you are moved out. You cannot say I just moved out because I didn't have number of assignments more or I didn't have time. Then they will simply say that they will blacklist you only in the institute or the MCA. So we have to be very careful here. That is why choosing the right client is very important. Even Ramalinga Raju said, I was on the tiger's tail and I didn't know how to get off. Similarly, we should not get into, so choosing a client we do properly, 80% of our problems will be solved then and there by not taking a client who we feel not comfortable. Later on it comes to that way, we have to take all these measures and see. We may have to withdraw from the assignment.
There are a number of challenges that is there nowadays. So how do we take care of those challenges?
You have to withdraw from the assignment. There is a separate process for that. There is in fact a guidance note by the institute on what are the cases where you can resign from assignment. There is a separate guidance note on withdrawal from assignments. You can't just like that withdraw. They cite certain things. For example, there is a restriction in scope, all those things, certain standards, they say you can withdraw. So you have to cite that and say that I have not been getting, or the accounts have been delayed for a long time, and then withdraw.
Qualification of the report, will it be enough? Qualification of the report.
Qualification. How will you qualify, sir?
Some supervision there, we report it.
You can say that.
Because
You can.
at the end of the audit, how to receive the fees?
You can say that. That is something that you have to take a call. So you can rather withdraw than give a free advice, right? Free qualification. So that's why you need to decide that. That is your choice. Now, qualification can be done. You can say that the fixed assets are capitalized at the rate of so which are not at market rates. You are unable to comment on this particular thing. Subject to this, everything else true and false, you can do that. It is your judgment there. Expert opinion is like a fig leaf, sir. You can take expert opinion. If that expert opinion helps you to get convinced genuinely, you can rely on that. You have to go as per our mind and conscience, sir. But expert opinion is also a very good thing. There could be some place where there's a reason for this also. You have to get that comfort. That is very, very important. Laws and regulations. Quick question. In your company, as part of their thing, there are some FEMA issues there. Will you put it in your audit report? They have not received the money within that number of things, or they are not paid. Payables also, there are some 2 years or 3 years. They are not paid it within the 2 years or 3 years. There is a FEMA non-compliance very clearly. Will you put this in your audit report? Yes or no? If yes, where? If no, why? Why not? How many of you say you will report it in the audit report? 1, 2, 3, 4, 5, 6, 7, 8. Okay. What is the objective of our audit? True and fair view, reasonable assurance, not material misstated. Are we supposed to see every law and regulation? There are 1,000 laws and regulations in India. Border Act, they are not followed. Dangerous Missionaries Act, they have not followed. Lift Act, they have not followed. Elevators. FEMA, they have not followed. Which one will you report? Which one will you not report? Where will you draw the line? This standard gives you the guidance over there. So, it talks about 3 things. One is, there is also no-clar. I will come to no-clar later. There are some places where laws and regulations, if not adhered to, have a direct bearing on the financial statements. For example, your Schedule 3. If they don't follow Schedule 3, financial statements has a direct bearing. Schedule 2, Payment of Gratuity Act. It's a law. If they don't provide for it, financials are not materially misstated. That is something you have to take a call. Income tax, memo of income not doing. TDS, I have to pay him 100 rupees. I should deduct 10 rupees, pay him only 90, pay 10 rupees to the income tax. I paid him fully 100 rupees. I have not paid income tax 10 rupees. Or the liability is there at 100 rupees in his name and not 10 and 90. Liability is there, completeness 100 rupees. True and fair view, no problem. Correct? True and fair view, no problem. And even the payment has been done, 100 rupees has been paid. Only thing 10 rupees has been paid to the wrong person instead of going through the income tax department. Pollution issue. In Manali, there are a lot of problems during this thing, effluent treatment, all those things. So, what the standard says is, there are certain things where it will affect directly. So, as part of your planning process, you have to first talk about laws and regulations, first understand yourself and talk to the client, which are the major laws and regulations that will affect the particular business. If it is Manali thing, some petrochemical or something, then that type of thing. If it is bank, RBI, housing finance, specific laws and regulations are there. Those things will directly affect your financial statements. So, wherever it directly affects you, or if you take an IT company, for him the major issue will be data privacy or cyber attack. Those things will not directly affect your financial statements. But we need to understand in every client, in their business, what are the major laws and regulations that will be a key audit matter for him, which will not allow him to sleep properly. Please find out that. Then distinguish it between 3 things. What will directly affect your financial statements, what will not affect your financial statements, what could affect your going concern. Pollution control, going concern. Now, the MD has a problem. He is in the news for some accident or some misbehavior, something, will it affect your financial statements? No. It's a personal thing. It's not even come anywhere in these things. So we need to react and judge and categorize things in the proper way. Where it is directly affecting financial statements, you are duty bound to get SAE, your audit evidence, proper audit evidence to get your conclusion. Where it is indirectly affecting, you have to make inquiries to the management, inquiry to the company secretary, legal person, get a confirmation of legal person, see the minutes. If there is something given there, I didn't follow the Boilers Act, or notice has come for not following the Dangerous Machineries Act, then you consider whether the penalty or something therein will affect your accounts and provide for it. Or more than penalty, they say, I'm going to lock the factory itself, whether that will affect a going concern. This is simple thing that laws and regulations says. No CLAR is something which is above a certain level of entities, they have brought it, they have diluted because the thresholds are very high. In international thing, no CLAR is very applicable. Chartered accountants in industry as well as in practice. There it says if you find a laws and regulations issue, how do you do a whistleblower type of thing? How do you attack the problem? You talk to if this problem is because of a particular personnel manager, go to the next higher up authority, discuss with them. Don't conclude. First inquire, understand the problem, mutually decide there is an issue, how to deal with it. No CLAR comes into that. No CLAR is part of our ethics. But auditing standards, this is what they talk about in terms of laws and regulations directly affect or indirectly affect. As part of planning also, you should talk about this to our audit team members. Entity failed to file GST returns for a period of 3 months. So only interest and penalty, provide for it if it is material, that's it. It did not come in your audit report. That FEMA matter asks first question, it will not come in your audit report. Environmental law thing, non-compliance could have a material effect on the entity's operations and financial position, going concern. So you may have to put an emphasis of matter, material uncertainty over going concern, will it come? If you say it is not a material uncertainty over going concern, but still it is flagging the going concern, note may have to be given by the management as per the going concern auditing standard. That will be taken separately by somebody else, just touching upon it. RBI guidelines violation, ability to continue as NBFC, then given emphasis, material uncertainty over going concern may have to be given.
GST, whatever any due, it's more than 6 months and all in Caro and all we have to put.
That could happen. See, when they,
It could. Then in Caro that you have
there are things. For example, you say as of the date of balance sheet date, whether the company can pay. One is dues which are there. That is also there in Caro.
43B and all.
All those things have a interrelationship with that. Even your Caro, where you say, are you able to make the payments also beyond for 12 months for creditors? That also going concern issue could happen. So there are interrelationship, but each one have to be attacked separately. So we have to categorize the laws and regulations, important ones. Some things are always there. Schedule 2, Schedule 3, or Banking Regulations Act, or IRDA, those type of things are there. Payment of gratuity, employee laws, direct tax, indirect taxes, all these things are the first category, directly affecting. Only TDS and all may not directly affect. Then other things are hundreds of laws for operations of the company. That is the second part. There you have to find out, have there been any non-compliances? How will you find out? Ask the management, get it in the MRL, get the legal confirmations, talk to the company secretary, go through the minutes of the meetings. If there are something you find out in these things, then see the effect of that, repercussions of that in the accounts, like fees or penalty. If it is material, provide for it. If it is not material, no problem. Communicate all these things to TCWG in part of your TCWG. Documentation also has to be taken up. Risk of notices, some payments without documentation, all these things could be triggers. As I said, these are the things. In the FEMA aspect, I talked about payables. If receivables not come for more than 6 months, that whether the receivable is good and recoverable is one part of the story. Non-compliance is different. Something could be good and recoverable but not received for 1 year also. That is a separate judgment that we need to look into. The next one, sir. Yes, please. Can you use the mic?
Give the emphasis of matter paragraph where there is an outstanding either in terms of payable or receivable. So what is your view on it, sir? Because when you're saying that the payable will not have an impact on the financial statements, and why they wanted to bring it in the emphasis of matter paragraph?
Emphasis of matter is not a solution for a qualification. It is not an apology of a qualification. If you do that, instead of putting in a qualification, we'll put in an emphasis. Client will say, we also say, okay, report panitom parna. You're standing in the middle of the road for the lorry to come and hit you. You rather keep quiet. I'm very brutal about it because so many people have done qualifications at the head as an emphasis of matter and stuck their neck out for unnecessarily. That is the first point I'd like to make. Second is, emphasis of matter says there are certain situations where it has to be done. Emphasis is where you ultimately say it is not a qualification, you agree with the management, but highlighting, merely highlighting. If you want to highlight, you can highlight. In this context, evaluate that and take a call. Your judgment.
Thanks.
Non-compliance can be given. Sometimes a major contingent liability is a contingent liability. Varumo, varado, no need to provide. Same time, no need not to disclose because it is not remote. But if it hits the company, it will affect the financial statements itself. But there is a big if highlight in UOM. It says, UOM reporting standard says that. Similarly, consider this. Next. TCWG 260 and 265 are more or less same. I'll quickly tell you that thing. TCWG, as I told you, management, TCWG, when we start the audit, are duty bound to tell those charged with governance that I'm doing the audit for reasonable assurance, not absolute assurance. This is the plan that I'm going to do. These are the aspects that we need to definitely talk to them. For example, independence, code of ethics, our responsibility, their responsibility, audit approach, planned scope and timing, significant audit risks that we have identified, management judgments and estimates which are there on which we are going to put our call also on that. Key audit matters if it is there. Materiality, how we are going to determine our materiality. All these things, at the planning stage itself, we have to communicate to TCWG in a written form, PPT, letter, whatever it is. NAFRA says TCWG is not audit committee, it is board. But there, our standard says, if you are given to a subset of TCWG, consider whether you have to tell the main TCWG also. You take a call, it says. The choice is given to us, but NAFRA says, please do it to the topmost authority. So many places we have only meet the audit committee, not the board. We give all the presentation to the audit committee. Please also communicate in a letter form to board also, putting the same PPT matter into the letter form or something like that. That is very important. Second is, TCWG also will benefit from our interactions. Then at the end of the audit, you say that significant deficiencies in internal control, significant findings or any significant matter discussed with the management, significant difficulties encountered during the audit, qualitative aspects of the accounting process, whether they have done accounting policies now correctly or there any you have any issues there, conclusions on audit risk, management judgments, summary of misstatements based on the materiality levels, management representation letter, we have given a MRL, we expect it to be signed and given to us by the whole-time director and the audit committee chairman. Reaffirmation of our independence again at the end of the audit also. These are the things that needs to be communicated to TCWG at the beginning and the end of the audit. During the audit, there are so many standards which says TCWG. As when it is triggered, please talk to them. Before you qualify the account, give an emphasis, anything other than a clean report, anything is going to come, talk to them. Follow it up by writing in some email or something saying that this is the thing, this is how it is, this is why you are giving this emphasis. Make them understand the situation. If it's a qualification, give them opportunity to remove the roadblock which will enable you to give a clean report instead of the qualification. So these are the things which we need to do with TCWG. In terms of the next one, 265, 265, same thing. I'm arguing with the IFC document. IFC talks about material weakness, then significant deficiency. That significant deficiency has to be given to TCWG, communicated. Deficiencies need not be communicated. This is what 265 is all about. 260 and 265 are more or less same. We'll quickly run through that. We're already 3 minutes past 1 o'clock. Give me another 5 minutes. Two-way communication. We also get to know from them what is their background, what is the control environment of the company, what are the key business risks during the year, what is that. We also get back from them also. It's not only we telling them, we also absorbing things from their side also. This is what we discussed. The board is inactive. Key decisions are taken by major shareholder who is also the MD. So who is the identification of TCWG? In the planning document itself, we have to identify who is TCWG and who is management. It's very important. And TCWG communication should be there. See, even in small audits also, we ultimately go and talk to the owners, or the next generation also comes, we go to the first generation and talk to them. They are the TCWG. We actually do a lot of these things, but we don't document it. We talk to them. Some documentation is required nowadays. Auditor's independence has to be communicated. Two-way communication. Next, 265. Auditors will communicate identified internal control deficiency. We are not doing internal audit, but while we do an audit, if we come across something, see, when we have some internal control issues, our reaction to the audit should be more substantive testing and ensuring that this particular aspect has been taken care of. Suppose we find, for example, there is some issue on identifying whether it's capex or revenue. Some problem is there. Then we have to increase our sample testing or do 100% testing on all the capex items additions to see that they are all capex and not revenue items. Plus go to revenue items like repairs and maintenance and do. So you have to change your audit plan slightly, document that change, do enhanced testing. Because of this issue of internal control, our true and fair view does not get affected. We have done more steps, more comfort, more audit evidence, more documentation. That has to be taken care of. Nevertheless, if this root cause has not been attended to, talk to them, communicate to them is what is expected from us. Oral communication does not replace written communication. IT controls, access right was, we talked to the people, they said, yes sir, there was an issue. One employee after he left also, he did something. Sir, no problem. We have to know, and our antenna should come up, we have to do more audit steps, see whether you have to communicate. Is it a deficiency, significant deficiency, your judgment. But you need to do that. So, the query list, that's column important. Is it a control issue? Yes or no? If yes, deficiency, significant deficiency, material weakness. If you go to material weakness, there is so much in PCAOB, actually, not in Indian context, but they are more matured level. But that's a topic for another day. Earnings management, the management is doing something, so you go directly to the board itself and talk to them. This is what we do it anyway. Ineffective entity risk assessment, they have not done risk assessment itself. Communicate, at least communicate that they have not done it. Tomorrow they should not ask us why you didn't tell us. So, control, unable to prevent or detect when there is a deficiency. The control is not able to prevent something or detect something or correct something, there is a deficiency. If it is absent also, it is a problem. The significance depends on the likelihood that the mistake can occur. It need not occur. the likelihood that it can occur itself is sufficient. Even for material weakness, that is there. That is also a judgmental issue sometimes. So this is typically given as a management letter from us to the TCWG. Management representation letter, they give to us. MRL, ML, the difference is very clear, we have to ensure. But it will be good to issue a ML at the end of the audit and discuss that should also be part of the presentation to the audit committee and follow it up with a letter also. That would be very ideal way of doing things. Sometimes it will be sensitive issue, could not be communicated to the management, then we need to see what to do also. This is where no clerk comes into picture also. So what to do when there is no remedial action? This is the thing. Repeat the communication and seek explanation. If failures to act, that is also a deficiency. Then enhance your thing. See whether you have to withdraw also sometimes. It's self-explanatory. So you can write a letter. There are a lot of management letters available for communication. If you go to Google, it's all available. In fact, TCWG letters are also available. Communication to those charged with governance. Many of the formats available in the Google, your internet is post-audit communication. Pre-audit, very few are there, but please go through that. That will also help also. So with this, we conclude this session. If there are any specific questions on any of the topics, we'll take it to the next 2-3 minutes. Thank you so much for the patient listening.
Thank you so much, sir, for this lovely session. I hope you all have learned a lot from this. Thank you so much. So we will proceed with the lunch, sir. Anybody has any question, please ask. You'll not get this opportunity again. Okay. So shall we proceed? Okay. We can proceed for a lunch, and it's a half an hour lunch session. So I would like to call upon CA Gauthami ma'am on the stage. Please join us, ma'am. Okay, before we begin the session, I would like to read on our upcoming program for the December, so that if anybody is interested, may enroll for the same. So we have 15th December, we have CP program on appeals and drafting. On 16th, we have a holistic review of learning for regulatory observations and contemporary practice issues. On 17th, we have CP program on valuation. 18th, CP program on mutual funds. 19th and 20th of December, we have National Conference on AI. This is being one of the pre-event of the National Summit on AI by the Ministry of IT and Communication. On 22nd, we have IAP jointly with Hindustan Chamber of Commerce and Tamil Chamber of Commerce. On 23rd, we have one-day CP program and audit process in RBIA. 24th, program on labor laws. 26th, we have one-day training program on peer reviews. 27th, a one-day program on ESG and BRSR. On 30th, we have program on Income Tax Act 2025. So if anybody is interested, please log into the website and may register for the same. All right. So we have CA Gauthami ma'am with us. So she'll be covering today technical session of SA 299 300 315 330 402 450 500 501 and 505. So she holds a bachelor degree in commerce and a chartered accountant. She is an associate partner in Price Waterhouse Chartered Accountants LLP, with audit experience of over 19 years. She has experience in handling Indian promoter group and has handled both listed and unlisted. She has strong working knowledge of international accounting and reporting requirements and has working on engagements requiring SOX reporting and reporting under US GAAP, IFRS, and US GAAP, PCAOB standards. She has been a special invitee member to the Corporate Law and Governance Committee of ICI. So now I would like to call upon CA Narasimha Perumal. Please come on stage to present the memento to ma'am. Thank you. Thank you, sir. So with this brief introduction, I would like to hand over the session to you, ma'am. Over to you. Thank you.
So good afternoon to everyone, and welcome to the second part of the session. And I hope it should be more an interactive session than being a monologue from my end, because I am definitely not going to take you through the standards. I'm sure all of you all are well versed in that. It's more an interactive discussion with more examples and any practical experiences which you all have encumbered, and then which can be shared here and which we can discuss. And I would want participation from the crowd, and let's keep it more interactive. I know it's a post-lunch session, so I don't want to keep it a very one-sided session from my end. I think with this we'll move on. We have about 10 standards to cover. So I think the first one is going to be on SA 299. So when we talk about SA 299, it's a joint auditors, right? And now with the RBI regulations, we see more of joint auditors in the NBFC, banks, where it has been made mandatory. And with that being said, even in statutory auditors, it still can be done, but then it depends on the audit committee and the board when they want to appoint. If they believe that they need a joint audit to be done, then that's done. Otherwise, it's mandatory for all banks and NBFCs. So with that in mind, and I will just take you through on certain key principles based on which joint audit is being done. Obviously, the joint auditor has to be appointed by the board and the audit committee. And the scope is very, very important, that what is the scope which is being agreed between both the auditors. I think that is very important. And the areas, say for example, in a financial statement, we are going to say that auditor A is going to do inventory, receivables, and payables. Then the auditor B would have the other scope being sales and your other, say your purchases, those. But there could be certain common areas where both the auditors will have to take care of. That's going to be the planning, the risk assessment procedures, where both of them will have to be involved, and they will have to sit through and do the planning meetings, discuss with the client, understand what the risks of the entity are. That's very important, and that's a combined approach which needs to be taken. So from a responsibility perspective, though the work can be allocated and agreed between both the auditors to say what each one would be responsible for, I think the key factor here is there could be certain areas which are there in the financial statements and which are off-balance sheet items, and certain planning and deliverables, especially your financial statements and your audit report, where it's going to be a combined one which will be issued. So in that sense, there will be more interaction between both the auditors. It is not that just because the scope has been divided between the two auditors, there is no requirement for an interaction. The communication between both the auditors are very, very critical, because when one auditor is working on certain areas, there could be certain observations or certain evidences which he is which he comes across, which could have an impact on the work which is being done by the other joint auditor. Then the communication has to happen between both of them. So that's very critical that both the auditors sit together, agree on the approach of audit, discuss with the client, agree on the scope, because that also has to be communicated to the audit committee. That is very important to say which auditor is taking responsible for which areas of the financial statements, and there also would be certain areas where there could be a common approach where both of them will have to get involved, and that's very, very important. So joint auditors, as I had mentioned, it is jointly and severally liable and responsible for the overall audit opinion, and the scope of the work has to be agreed with the auditors and with the management, and it needs to be communicated to those charged with governance. That's very important. And each auditor is responsible for their area. Yes, whatever area has been allocated to them, each auditor is responsible. But as I had mentioned, there could be certain areas where both of them are equally responsible, and that needs to be clearly focused. And so the ongoing communication between the auditors become very, very important. You will have an overall audit strategy. So planning is going to be a combined. So audit strategy will be combined. And what are the risks which are being identified? Because when you're looking at, we will, in the upcoming slides, we will see on 315 and where you will identify the risks and all of those. So the risks for the entity will have to be discussed and agreed by both the auditors, and the audit approach will be based on the risks which are being identified. So that is very, very important. And so the risks will have to be identified, and the audit strategy, the laws and regulations, the compliance of laws and regulations, litigations, all of those will be a combined area where both the auditors will have to agree upon, because both of them are going to agree upon and they're going to sign on the financial statements and the audit report. So in that sense, the other items other than the respective work areas of allocation which is being done between both the auditors, this is also very important that they agree on that. And obviously you will have a combined engagement letter. So the engagement letter in that sense is not going to be that when two auditors are there, auditor A will issue an engagement letter only for the work which is done by him, and the auditor B issues for his work. It is not like that. So it is a combined engagement letter. So the responsibility lies with both the auditors, though there is a division of work which happens between both of them, but they are responsible to the stakeholders as a joint auditor. So each of them takes responsibility. So there's a combined engagement letter which needs to be entered into. The scope is agreed, and the letter of representation or the management representation letter, which we call it as MRL, that is also a combined MRL which they will have to get it from the management. So that is very important. So any questions anyone has, please feel free to stop and ask any practical examples which you will want to share. We do have certain examples here, but anything over and above that which you've encountered and which you believe needs to be discussed with a larger group, please let me know, we can discuss as well. So this is a case study. So a company appointed joint auditors to conduct the statutory audit. However, the commencement of the engagement, there was a confusion in the area of allocation as to what areas they will do, leading to an overall lap of procedures and duplication of efforts. Whether this could have been avoided, the answer is yes, because the standard clearly calls out that both the auditors will have to sit together and then agree on the scope, first understand the entity, the risk, and agree on what each auditor is going to be clear, so that there is no overlapping. But that does not mean that when you are auditing your specific area, there's something which you've stepped upon of the work which is done by the other auditors, or where you believe that there is a red flag, right? Then you will have to inform the other auditors. Say for example, let's say you are looking at receivables, right? And you're looking at aging of receivables, and you're looking at certain customer disputes which is coming up, and the responsibility of litigations is with the other auditor. Then you will have to keep that auditor informed to say that this is something which I've come across and which we believe that you should also look into, whether as part of your scope you are covering that, and whether that's something which you've also inquired with the management. That is very, very important. So that communication between both the auditors becomes very critical, because from a stakeholder's point of view, from a shareholder's point of view, right, they are looking at, from an audit report, yes, there is a division of work which is there, but for them it's going to be one set of financial statements and the audit opinion. If you're issuing a clean opinion, then they have said that as professionals we've looked into the respective areas, and then we've performed enough audit procedures, and then we've discussed, and then we've concluded. So in that sense, then you will have to have this ongoing communication between both the auditors. So as per 299, the joint auditors are clearly required to define their scope and then the division of work. And the divisions is clearly specify which all audit areas each one is doing, because that you will call out. Even in the engagement letter, you will clearly call out for each auditor, they will call out what is going to be their scope of area and what is going to be certain common areas which both the auditors will look at, right? So that has to be called out, and that is very important. If that was done, then the situation of what was mentioned here to say there is a overlap of work which is being done or a confusion, because from the client end as well, obviously they will not want to give the same set of information to both the auditors, right? So that efficiency they will also expect. So then this becomes very critical that upfront that you agree on the scope. This document plan should be mutually agreed, signed. Obviously, this will be signed as part of your engagement letter to say what is it that you're going to look at, what is it the other auditor is going to look at, and then that has to be communicated to those charged with governance, because they should also know from an audit committee perspective to say that what is the area each auditor is looking at. So that is very important. So the formal documentation and enhanced accountability, it will avoid any overlap of work. So the second situation is where a company appointed joint auditors to conduct its statutory audit. However, at the commencement of the engagement, I think there's a repetition. So during the joint audit for a manufacturing client, one auditor identified a significant revenue recognition issue, whereas the other believed the presentation complied with the accounting standards. So in this case, one of the auditors has identified a revenue recognition issue, and while the other auditor believes whatever he's looked at is appropriate. Now the question is whether the auditor A has to communicate to auditor B. The answer is yes, because as part of our professional ethics and the judgments, right, we will have to communicate, and the standard also says that it has to be communicated irrespective of whether the revenue was in your scope or was in the scope of the other auditor. So that is very important. So it requires to communicate, consult with each other, and if there are any disagreements, then you will have to see how that can be ironed out, whether you're going to get more information from the management. That is very important, and then that issue has to be ironed out. If there is a disagreement, right, then that needs to be put up with the those charged with governance to say that there is an issue where we tend to disagree and we need no clarification, and either of the auditors would have to agree, otherwise it will have an impact on the audit opinion. So that becomes very important. And the other example is where a joint audit was appointed for retail chain with multiple branches across the country. Each auditor was assigned specific geographical locations. So they have divided their work based on geographical regions, and with limited communications on audit procedure and risk assessment at different locations. So they have divided, there were various, it's a retail industry, so it will be spread across various regions. So they have divided their work based on the geographical region. Say for example, I will take care of whatever sales is happening in the Tamil Nadu region, or the other auditor is saying I will take care of the Karnataka region. You can divide the region, but from a risk assessment perspective to see what are the risks you are looking at, say from a revenue, right? You will look into the revenue of Tamil Nadu, and the other auditor is going to look at the revenue for the Karnataka region. Then whether you have agreed on the risks, what are the risks you perceive in revenue recognition? Have you communicated? Have you discussed? That becomes very important, whether that has been done. And in this case, so to comply with, I think the standard says that yes, you will have to discuss, agree on the risk assessment being done and what are the audit procedures which you're going to perform. But it is not important, or it is not mandated that what all the audit procedures which are being performed by auditor A is being done by auditor B. Each one can use their professional judgment to see how they get comfort over the relevant financial statement line items. But the risk is very important. Whether we've assessed the risk, that is very important, and whether that communication has happened, that is important. To improve communication and coordination, minimum duplication, I think comprehensive, they could have done a risk coverage to see who's doing what areas, what is the coverage they are going to get, instead of not having an upfront plan to say how they're going to approach the audit and what is the audit process or the audit procedures which they're going to perform. So here you have segments where there's a manufacturing segment, there's a trading and services segments. So they appoint 2 joint auditors. Accordingly, Auditor A is assigned responsibility for manufacturing, while Auditor B is responsible for the services division. Both the auditors recognize that certain critical areas like cash, investments, because these are not going to be at each segment level, right? This gets into the corporate level. So then who is going to take responsibility? So since both of them are validating different segments, then this common segment of this common assets would need to be validated by both of them, and maybe they can share their work papers or see how the other one has done, what procedures they have performed to get a combined comfort over the balances of cash, investments, taxes. Generally those kind of areas will come under the common areas where both the auditors will have to look at it. Litigations. So those are certain examples where there could be these are the common areas, and maybe both the auditors will have to sit together and frame up the procedures to be performed, and whatever observations they have, they will have to discuss and agree to close those. And if there is a disconnect, right, then they will have to see how they're going to sort it out, ask for additional evidence. So that is very important. So I think this is what it calls, and the joint report. So any questions you all have on joint auditors? I think we will also look into the key principles again, but in short, the joint auditors, you'll have a combined engagement letter where the scope is clearly agreed between both the auditors as to what is the work each auditor is going to pick up, and there could be certain areas which would be common for both of them to look into, and their focus has to be on that, and there has to be a common platform or a communication has to be on an ongoing basis between both the auditors. It is not that you meet the auditors only at the planning stage and then it's finally when you sign out the financial statements you get to meet each other. It is throughout the audit process, both the auditors would have to keep communicating between each other and share the audit observations they have to see if whatever areas which is not part of their allocation, whether it will have an impact. The onus is on both the auditors. It is not on one person. It is on both the auditors to sit together and have that ongoing conversation. So that is very important, because based on the whatever work we have done is where the audit opinion, when you sign the audit opinion, it's going to be a single audit opinion where both the auditors will have to sign, right? So in that sense, you'll have to really interact and communicate. That is very important. So the joint auditors will jointly establish the overall audit strategy, and they'll develop a joint audit plan as to how they want to go about doing the audit. I think we discussed on the risk of material misstatements, on the common engagement letter and a common manager representation letter. Now from a responsibility perspective, it is joint responsibility. Though there is division of work, they are responsible for their areas of allocation, but from an overall perspective, both are jointly responsible for the work whatever has been done by them, and especially on the areas where which has not been divided by both the auditors, then they are jointly responsible. So when we say jointly responsible, let's say there's a litigation, right? Say there's an indirect tax litigation, and now that's a common area, right? So what do you think would be the expectation? If one auditor believes that this is a high risk and they believe a provision has to be made, right? Whereas the other auditor believes that it is fine that it is disclosed in contingent liability. So is there something which they can sort it out, or if they are unable to do it, what do you think would be the option which has been left? Sorry, sir? Okay, that's one option. Each auditor can give his own opinion. Sorry? You can go to an expert committee, okay. Maybe you can also look at getting a expert committee. When we mean a formal expert committee they can go to, or they can also get a legal opinion or an external opinion, which is also doable, where it's a common, it is not somebody who's connected with both the auditors, and external opinion they can get out, and then maybe based on that the auditors can conclude to come at a common platform to say whether it has to be disclosed as a contingent liability, or if at all a provision is required, then a provision will have to be made. And what if there is a disconnect? Even after that there is a disconnect, then what is the way out? Yes, there will be another matter paragraph where they will have to call out to say, in this area I tend to disagree, and you will refer to that, and it will come as an other matter paragraph. There is where you will have to call that out. So it's a common audit report. So both of them will have to sign. So that says if there's a litigation and there's a disconnect between both the auditors, then in the other matter paragraph you will have to say where the disconnect is, and to that extent you say I do not agree. So that's something which you will have to call that out. Yes, sir. Yes. 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 Signed. Yes, that's right. So it is assumed that in a normal scenario that whenever the areas are being allocated, each auditor has carried out his audit in a responsible and in a professional manner, and it is believed to say that all the accounting and the auditing standards have been complied with as far as their areas are allocated. So in that sense you will not go and review the work of the other auditor. The responsibility is divided, but there is a common area because you're working on one client, one entity. That common discussion point will be there, but that does not mean that you will go and review the work of the other auditor. So there the scope is very clear. So if there are any modifications, any other matter paragraphs which we believe, then that needs to be communicated to the audit committee, like how you do in any other, even if you're issuing an independent separate audit report, those observations, audit opinion observations will have to be communicated to the audit committee. The same would also have to be done here as well. So there is no deviation in that sense from this. So any questions for SA 299, anything which you believe needs more clarification or? Okay, so then I'll move to the next one, which is SA 300, which is on the planning on audit of financial statements. So what do you all think when we step in for an audit? What is the planning which you will do? Strategy, audit strategy, okay. Staffing. Deadlines. Sorry? Requirement list to the client, okay. Allocation of work to the staff, okay. Materiality. Scope of work. Okay, so this standard would cover on how do you plan an efficient audit, right? As you had mentioned, planning is a very important phase in an audit, where you will have to understand the client, which is very important, because what you've understood in one client, the same audit procedures or the approach cannot be, it's not a copy paste from one client to another. Each client, you'll have to understand their business, understand the industry, understand what the risks are, and then you accordingly you plan what work needs to be done. And before we start planning on the work, there are certain procedures also which you will have to do, right? If it's a new client, then what are the acceptance procedures you have done? What is the risks you've identified in that client? Have we looked into that before you plan for the field visit? So all that is also very important. So once all your risk procedures are done, you've onboarded the client, then the audit strategy comes in, right? As someone had mentioned on audit strategy. When we say audit strategy, it is about One is on the risk procedures, risk assessment you've done, and what is the approach you're going to do, right? If it is a IFC client where you're going to issue 2 opinions, then obviously there has to be a controls also you will have to test, and you're going to rely on controls. Otherwise, it's going to be a substantive approach where you will do a test of details. Now, what is the approach which you're going to follow for the client? So that is very important. What is the strategy for the client? And whether you've derived any comfort from ITGCs. That is also very important. If the ITGCs are not functioning in a client, and then obviously you cannot rely on the automated controls. Now in that scenario, how do you devise the audit strategy? So that becomes very important, whether you're going to rely on manual controls and give a clean IFC opinion, or no, I am not able to rely on the manual controls also, so that's going to be a qualified opinion or a disclaimer or a adverse, whatever based on the assessment is. And what is it that you're going to do on the financial statements from the numbers perspective, the main audit report. What is the audit strategy which you're going to follow? Because based on whatever your conclusions are there is where you will see which all FSLIs you will consider as significant risks, and what is the audit procedures you will perform for those. At assertion level you will have to do. So that has to be done as part of the planning, because that is very important. And even from a team perspective, right, you send the team without having proper discussions or any audit planning meeting within the team, they will just go and they will not be able to, if they are new, then they will not know what the client has done. And even experienced people, if there's something or some regulatory change which has come through, or there's a change in the client's business, then if that calls for certain audit procedures to be looked at, then whether that communication has gone to the team members. So that is very important. So the discussion with the team before you start the audit is very important, to get them up to pace to see what is it that the expectations are. What are all the areas, as they had mentioned on the work allocation, what is the area that each team member has to do, and each area you will have to discuss, brief with them, tell them what is the expectation. Say for example, you take a cash and bank, then what is the expectation which you will want them to do, whether you're going to ask them to circulate bank confirmations, and if the confirmations are not returned, what are the procedures which have to be performed, whether they're going to look at bank statements, look at reconciliations, what are they going to do with unreconciled items. So all of that clearly that has to be communicated. And say for example, you're doing a revenue, there is no controls, where you are not able to rely on controls, then what are the audit procedures which you are going to perform, and whether you will do it at low, moderate or high samples. All that has to be done at the planning phase. It cannot be done at the end of the audit when you go for a closure meeting. That's when the partner or the manager is looking at the work which is being done, and then they say that no, this ideally should have been a high risk or a high sample size you would have done rather than a low. So all that will have to be done at the planning stage. So it provides the guidelines for the audit plan, and a detailed audit plan would include the nature, timing and extent. So the nature, timing and extent will flow from whatever your audit strategy is. To say for example, the standards on auditing calls out 2 risks as significant risks, right? You don't rebut those risks. Those are the management override of controls and revenue recognition. And revenue recognition, of course, at the assertion level, certain risks can be rebutted. If we believe the inherent risk in that assertion is low, then you needn't have to take it as a significant risk. Now for that, the discussion will have to happen with the team, and it is very important that the team also contributes in the discussion. So they are the ones who are going to perform the work on the ground. So they should also provide that input. So that's very important that all that is baked as part of the audit plan. And this is not a one-time exercise which you will do. As you execute work, if you believe whatever you've set as part of the audit strategy in the beginning of the audit, whether it requires a change, then that also needs to be done. That is very important. So plan the audit in an efficient and effective manner. Audit strategy, as we had mentioned, agree the scope. You had mentioned on the scope. So scope is very important. Of course, in a statutory audit, it is going to be all areas, but based on materiality. right? So how do you fix the materiality? So that you will have to look at, and what all are the areas which the audit team is going to focus, and there could be certain key focus areas in an audit, right? Say for example, the company is making losses. Then you will have to look at impairment. Impairment becomes a key focus area. So what are the key focus areas which the team would have to focus on? So that needs to be agreed. And then active participation of the partners and the team members is very important, because they are the ones who are going to perform the work. So they should be very clear on what they need to do, and also on any regulatory and changes which are legal changes which has happened, then they should be aware of and they should be informed about the same. So preliminary activities, as I had said, the client acceptance, independence is very important. I think in any statutory audit, independence of the auditor is very important, not only of the audit firm or the sole proprietor, it is also on the team members, whether they are independent, especially if it is going to be a listed client, right? Then they will be handling unpublished price sensitive information, right? Whether the team members, especially the junior team members, are aware of what they are going to handle. So that is very important. And then those discussions and trainings with them is required, because whatever which is being discussed as part of an audit team, that should not be discussed outside with even their family members, and especially on the financial data, because there could be financial statements which is provided to the team members to review, and then they shouldn't be leaving it on the table or taking it home and leaving it out, because these are very price sensitive information. So all those trainings will also be needs to be provided to the team members. That is also very important. And the engagement terms, that will be your engagement letter based on which you will be entering into the audit. So that's very important. Update the strategy as the audit progress. As I had mentioned, if you come across any observation which you believe requires a change in the audit strategy, then pause, go back, change the audit strategy, and then you will have to carry out. So the involvement of the senior team members is very important, because the junior team members will be on the field, and if they identify something, then the discussion has to happen, the review has to happen, so that you can go back and change the audit strategy. So communication within the team and between the senior team members and the junior team members is very important. Plan, direct supervision and review of team members, as I had mentioned, is very important. Only then, in a timely manner, you will be able to see if that requires for a change in the audit strategy. Otherwise, the team members will be carrying on their work in their pace, and then at the end of the audit, you will go and you will identify that there are certain key critical elements which the team has missed to see. So it is very important that proper supervision and guidance is provided to the team members. That is very important. For initial audits, of course, acceptance procedures, and you will have to communicate with the predecessor auditor. That is very important, right? When you're taking up a new client, you will have to write to the predecessor auditor asking for a no objection. That is very important to say if there are any difficulties which the predecessor auditor has experienced, basis which the client has, the auditor has moved out and they've appointed us as the new auditors. That is very important. And the other one also, which goes as part of the predecessor auditor, is if there are any unpaid dues, disputed dues which are there, right? So those are very important. So that also needs to be done as part of the audit planning. Any questions, or there are certain examples, maybe we can go through that. Okay. During the audit of XYZ Limited, the engagement partner observed the audit team began testing transactions without defining the overall audit scope approach. So he realized that without a clear strategy, the team might overlook significant risk areas. So this is where it is very important that before the team hits the field, that the engagement partner is involved to tell them what are the procedures, what is the focus area, as we had discussed. All that has to be discussed and communicated. So if they had applied SA 300, then they would have ensured all these procedures are being done, and the audit process would be a smooth process. So during the audit of NE Limited, the auditor initially planned limited testing for receivables based on expectation that internal controls are effective. Then as they tested the controls, they noticed So as they progress with the audit, they noted that the controls were not effective and they had to rely on, they could not rely on the controls. Now the question is, there's a change in the audit strategy, right? Initially you thought you will have reliance on controls, so maybe you would have looked at to performing all substantive procedures at low. Now there is a change in audit strategy because the controls have failed and there are control deficiencies which have been identified. So this requires for a change in audit strategy. So it is not that the audit strategy is done in the planning stage and then at the completion you come back and sign off. It is a continuing process throughout the engagement, phase of the engagement, and wherever it is required you go back and change the audit strategy. And in this case, of course, this will have an impact on the audit opinion. If it's an IFC, because you're having an ineffective controls, you will have a qualification in the IFC. And from a main audit report perspective, you could still perform substantive procedures to get comfort over the numbers, and basis which a clean audit opinion can be issued, but that's left to the professional judgment of the auditor, whoever is auditing the client. So in this So in this case, the audit firm took a new audit client in the retail sector. The client's operations and financial systems were unfamiliar to the audit team, creating uncertainty about significant risks and potential audit approach. Now, here one is from the client's operations, because it's a new client, the team will not know how the operation, so you'll have to spend more time. The other is the systems also. That is very, very important, because unless as an audit team we know what are all the systems which are being used, especially when there are multiple systems which the client uses, it is important that all the systems are scoped in for audit, because the source documents from whichever systems the source documents are coming from, that needs to be scoped in. So that is very important that we understand how many systems, what are the systems which is being used by the client, and that gets scoped in, because otherwise then your overall audit strategy itself will go for a toss, because you would have put your audit strategy based on your understanding without scoping in a particular system, but then as you do the audit, you realize that there's a system which we've missed to scope in. Then you'll have to go back and change the audit strategy. So that is very, very important. So this is more observation where the client was looking at the potential fraud risk related to accounts receivable. And as they progress, they realize that they need to focus more on accounts receivable and perform additional procedures. Maybe liquidation procedures is one option which they can look at to see subsequent collections if that has been made. Confirmations is one option which they have. So they will have to look at each procedure as they start performing the audit. So that is very important. It is not rigid. The audit strategy and the plan is not rigid. It is an ongoing continuous process, and you will have to keep changing if you believe that it requires for a change based on your understanding. So any questions on this standard from the audit plan perspective? Okay, so then we can move to the next one. This is the SA 315. I think this is a very important standard, because the audit strategy will somewhere depend on ISA 315 as well, right? This is where you are understanding the client, identifying the risks and the controls, right? And then there's ISA 330, which calls for the response to the audit risks and controls which is being identified here. So that is very, very important. Now, how do you identify the client's risks? What do you think are the ways in which you can identify the client's risks and controls? Through walkthrough, yes. That's more from a business process level, you will start going for a walkthrough. But before you get into the walkthrough, you will have to understand the client, the industry and the client, right? That is very important, because once you get into the walkthroughs, it will become more at the process level, right? Process level is something where you will anyways end up auditing those financial statement items, so which you will come across. But understanding of the client and the risks are very important, because based on that is where your entire audit strategy will be. So understanding of the client is very, very important. Their environment, the control environment in which the client functions is important. How good the corporate governance are. How do they monitor? All that is very important. And also from a risk perspective, what do those charged with governance look at risks for the company? That is very important, because our risks more or less will have to align with the risks which the management also perceives. Say for example, they believe that revenue is a very significant risk for them, business risk for them, because their sales incentives, the promotions, your ESOPs, all of that are dependent on revenue. In that sense, then when we are doing the audit procedures, or when we are scoping in our risks or looking at our risks, we cannot say revenue is not a significant risk, because management themselves believe it is a risk for them, and then we will also have to align with those risks, because that becomes very critical. So unless we have those meetings with the client, understand what their risks are, how they perceive their business risks, how they perceive their other key risks, we will not be able to step down and see what is going to be our audit risks. So that is very, very important. So understanding of the client is very important, and having those conversations with all the functions is important, so that we get an overall understanding of the entity as a whole. So as we had mentioned, understanding the entity environment, including internal control components, right? So you have the COSOs, right, which is the control environment, your risk assessment process, your information and communication, monitoring of controls and control activities, which we call them as the COSO environment for a client. So you will have to understand all of those to identify and to see what are the risks. Say for example, in a control environment is where you're looking at those charged with governance, right? Who are the directors? Who are the audit committee members? What is their competency? How are they? In which other companies they have been directors? What has been, are there any negative news about those directors, right? All of that is important. As part of our planning, you will also have to understand the control environment, and it is also about how they are monitoring or through the board, how they are monitoring the affairs of the company. So that is very, very important. So control environment is one, and then the risk assessment process. As I had mentioned, what are the risks which the management believes? That's very important. So he has to assess the risk of material misstatement, whether it is due to fraud or error. If it is due to error, it is a lesser risk in that sense, because if the errors can be corrected, then that's something which we can live with, and it does not affect our audit opinion. But where it is a fraud, right, then it is a bigger issue. So we will have to identify what are the risks of both misstatement on account of fraud, and what are the risks which can be on account of errors. Both has to be looked at together. How will you do it? Inquiry. So you will have meetings with the management, meetings with the finance head, the CFO, the stores person, the production head, so that you collect the information from all of them, corroborate all the evidence, and then come to a conclusion to say whatever each person has said, you are able to interlink and get that connected. It is very important that as auditors, we shouldn't stick ourselves only to the CFOs or the controllers. It is outside the finance function. We will have to interact more to corroborate whatever the CFO is saying. Say for example, the CFO is saying that the company is making losses. So the CFO is saying, in our planning meeting with the CFO, so he's saying we will be making twice the revenue next year. That's our target, and we believe we will be able to meet the target. Now this is from the finance function, because a CFO would know the impact of making losses would be, if there is going to be an erosion of net worth, then it is going to have a trigger on going concern, right? So he is giving us in our planning meeting to say that we will be making profits from the next year, because we are going to double the revenue, saying that we brought in a new product, so that is going to hit the market. So he would give various explanations to say how the revenue is going to improve the next year. Now, are we okay with just interacting with the CFO is the question. The answer is no. You will have to go discuss the same with the marketing head or the sales head to corroborate whatever the CFO is saying is what the sales head is also saying, right? Because if he is going to say, we've launched a product, but we are unsure whether we will have the customer we'll be able to attract the customers at the pace at which we are looking at, right? Then the question of whatever enquiries we had with the CFO, we will have to revisit, right? So that becomes very important that we connect with all the heads of the department, including the CFO. CFO is required, but the other heads of department are also equally important. So that is very critical. So you will do analytical procedures, observation, inspection, right? So if he's going to give you a budget, you will look into the inspect the budget, and then you will see if whatever is being provided is appropriate. So it will be gather evidence for the ISA 315 would be all of those where it's going to be inquiry, observation, inspection, and the analytical procedures. So as I had mentioned, that it is also a dynamic process. So if there's going to be, you've done a control environment where you've assessed how the board monitors all of that, and there's a change in the board member, which is very key. Then you will have to revisit during the course of audit to see if you'll have to go back and revisit your control environment. If a key board member has resigned, right, then you will have to see why that during the year he has resigned. Has there been any conflict with the other board members? Has he given any dissent note? So all of that will have to be looked at. So like I had mentioned on the audit strategy, where it will undergo a change, it could undergo a change even at the execution stage. The same is with the control environment assessment as well, and the ISA 315 assessment we have done, because that can also undergo a change, because you would have done based on the assumption that there is no change in key management personnel, so you believe that to be a lower risk, but then suddenly there is one of the key directors resigns. Then you will have to revisit and see whether that is going to have an impact on the audit which you are going to perform. So business model and the 5 COSO components which I had mentioned. So here in the example, during the client acceptance process, the audit team noted several red flags in the change in the ownership. Now, whether this has to be factored as part of the ISA 315 assessment, the answer is yes, they will have to factor, and the downward will be that how will you look at the audit risks. One is the risk of losing a key management personnel, then how is going to impact on the revenue or the targets which the management has set up for themselves, how they are going to achieve and what are the risks. So that is very important. So whatever you are doing at the client acceptance stage or at the planning stage has to be combined at the execution and when you're completing the audit as well. That is very important. So the engagement team here has reviewed the company's extensive internal control framework. So the 5 COSO framework they have reviewed, which includes controls over staff attendance, production scheduling, and financial reporting. So as part of your control activities, you will look at the walkthroughs which we had mentioned, right? So each process you would have done a walkthrough. Now the question is whether all the controls, whatever the management explained to you, whether you will take it as part of your key controls and test for IFC is a question. Whether it is an operational control, you needn't have to, which has an impact on the financial statements is where you will have to look at and then test those controls. So that is something which you will have to assess. So here they have looked at certain controls where production scheduling is, will that have an impact on the financial statements directly or indirectly? It may or may not, right? Because it is more for the purpose of production, but then as part of the inventory valuation, if we believe that this is a very critical element, then you will have to look at that control, otherwise you can scope that control out. So understanding and discussing those at the right time is very important. So here in this company Technova Limited, the auditor noted frequent errors in sales data but did not evaluate the company's IT controls. So this is the information and communication of ISA 315, right? They are one of the other COSO component where the auditor has failed to see or rely on the system controls or look into the ITGCs, because when you are doing your audit at the execution level, you've noted lot of errors which have come up. Now the question is, why these errors are coming up, the root cause of the errors will have to be analyzed, right? Because we would be doing on test check basis on samples. Now, in that samples, whatever we've picked up, if there are repetitive errors which are coming, then there is a red flag there which we will have to look at to see if there are any errors which are creeping in on account of ITGCs. So in this case, it was later found that weak access security and unapproved program changes. So somebody had access to change which didn't require an approval. So maybe because of that deficiency is where there has been changes in the, say, the prices, right? The accuracy we are talking about. So the prices would have been changed without getting proper approvals. Now, based on this, now your audit strategy will change. The answer is yes, the audit strategy has to change, because you will have to go back, maybe pick more samples and see, or maybe you'll have to do a data analysis to see how many changes have been done, whether they have been correctly reflecting, and what about the controls. If the ITGC controls have failed, what happened to the manual controls, right? All that will have to be looked at. So this is a pretty straightforward one where the revenues are linked with, the bonus are linked with the revenue targets, and then whether there is a heightened risk of fraud. The answer is yes, right? Because there is a risk, so you will have to look at revenue and then test, because here one will be the completeness of the revenue and the other will also be the cutoff, whether the upfronting revenue to meet the target and get more bonus. So that analysis will have to be done as part of the ISA 315 assessment. This is very, very important in identifying the related party transactions, right? There could be, when we ask the client for the list of related parties, they could share the list of related parties. Then how are we comfortable whether that list is complete, right? So that is very, very important. So you will have to interact with the legal team, right? The head of the legal, to say whatever list of related parties the client has given you, whether that is complete, because they will know on what are the other companies which are related to the company which we are auditing. So that is very important. So that is very important, and whether the transactions with them are in the normal course and arm's length, right? If you see all the NAFRA inspection reports which are coming up, it is all on related parties, on the completeness of related parties, and whether the arm's length has been tested. Now here, arm's length has been tested, you could still get a transfer pricing report and say, yes, based on that I've relied as an auditor to say that the transactions are at arm's length. But if that's the only procedure we are going to perform, is it okay? The answer is no, because if you see the recent NAFRA reports, it clearly calls out, as an auditor, independently, how are you comfortable with the transfer pricing report which has been provided? Yes, he is an expert, he is provided, but how are you comfortable? What are the additional procedures which you have performed? So maybe you will have to look at that to see what are the additional procedures as an auditor I will have to perform. So what do you think in this scenario for related party transaction? You have a transfer pricing report. As an auditor, what procedures do you think we can perform to say the transaction is at arm's length? Then I would need answers. I mean, how do you think you'll feel arm's length? The transfer pricing report, they'll give you a range, right? It is within the range, so we are fine. But then from an arm's length perspective, as an auditor, how do we get a comfort to say, other than relying on the transfer pricing report, what are the procedures you think we can perform? Perfect. So there could be transactions where the same product has been sold to a unrelated party, right? And what is the rate in which they have sold? And then whether what is the rate which they have sold with the related party? And then that comparison, it's very easy that way. When a product is not customized, if the same product is sold to a related party and unrelated, it is easily comparable. But when it is a customized product, right? Each of the products are customized to the needs of the customer, then it becomes difficult to do that comparison, because there could be certain other scope or any other additional work which is being done for that particular customer to charge him that rate, right? So in those scenarios, maybe an option which would be the margins which the company is making on those customers, right? That could be an evidence to say, compare that with the related party transaction, what is the margin which they are earning here, to say if it is at arm's length. When we are saying it is an arm's length, it is not that if you are selling a product at 350 to a customer, a third party customer, the same 350 has to be done to a related party. It is how that the range is seen to be reasonable, right? That is very important, and the margins are important because other than relying on the transfer pricing report which is being provided, it is also what are the procedures which we have to perform. That is very, very important, and that needs to be documented. That is very critical. So they were undisclosed. We will get the related parties, we get the disclosure of interest from the directors, right? The expectation is they will have to disclose. Now we will have to compare with that list whatever is provided by them with that of the transactions or the ledger scrutiny of the vendors or the customers to see if any of the related party, though the client has not called out as a related party, whether we've identified. So that becomes important. So as I had mentioned, risk assessment process to identify and assess the risk of material misstatement both at the financial statement level and the assertion level is important. The risk assessment procedures alone do not provide sufficient evidence. You will also have to perform execution and controls and other execution procedures. The risk assessment procedures will include inquiry, observation, inspection, analytical procedures. All of that are done as part of the risk assessment procedure. Involvement of the partner is important. Key team members are important. You will plan the audit based on the risk assessment you have done and the past audit experience, right? That is also very important. If you've identified any errors in past, any control deficiencies in the previous year, then how have you factored as part of the risk assessment for the current year becomes important. And based on that, you will perform your audit. So the COSO framework, as I had mentioned, the company's control environment, the strategy, all of that will have to be looked at, and whether that is aligned, whatever the company's strategies are aligned with the company's business is very, very important. So the control environment, as I had mentioned, is with oversight of those charged with governance and whether they are doing with ethical behavior and whether that is getting communicated, right? The communication to the employees, the suppliers, the customers are very important. Whether that communication is also happening, how strong the control environment is, that is very important. Risk assessment process, we said on identifying the risks, the likelihood of the occurrence of the risk, and then how do you reduce the risk by performing audit procedures and identifying controls and performing the audit procedures is very important. So these are discussions with the management where you don't have a proper document of process and control, but still it is not that you will have to qualify the opinion, right? Based on your inquiry, you firm up an audit process, and then the controls, obviously the management is operating, maybe it is not formally documented. So maybe we can look at that and then perform our audit procedures. And if there are no, and the controls are also not operating or controls are not designed, then there's a control deficiency and which will have an impact on the audit opinion. So whatever our observations are on the control environment, deficiency of controls, our audit process, then those needs to be communicated to the those charged with governance and the regulatory authorities if required. So monitoring of controls is nothing but if the client has an internal audit team, right? Through them they will monitor to see how the operations are happening. So that's one example for a monitoring of controls. Then through their monthly reporting systems they will have, MIS they will have, through which the management will monitor the operations of the company. So those are the monitoring of controls which we can rely on and look into to see if they have been appropriately operated for us to perform our audit procedures and identify, strategize our audit plan and then perform the required audit procedures. So in exercising judgment on significant risk, whether the risk is a risk of fraud or a risk of error is very important. And then what are the when you are looking at not only from a client's perspective but from external environment, right? If there are any regulatory changes, say for example there is a tariff impact, then how is that going to affect the company? So not only the internal regulatory matters or internal operations of the company, it's also how the industry is going to be affected by external regulators. So that becomes very critical. So that also needs to be factored when we are doing our risk assessment process. That is very important. So this is on the substantive audit procedures which we will perform. It is not only 3 substantive audit procedures, we will also perform controls and maybe certain specific FSLIs which we will focus and ensure that the audit procedures are accordingly factored, and we do that. And when there requires a revision of risk assessment, then we go back and change the risk assessment and then re-strategize our audit. That is also critically important. So it's not only about performing, it is also about documenting, right? So documentation of everything in the file is important. Your initial risk process assessment, what is the change, what has caused the change, and how your audit strategy has changed based on the risk assessment process you have done. So all that needs to be documented at the financial statements level and at the financial assertions level, and what is the audit evidence you've looked at. That is also important. I think with that we'll move to SA 320, which is on materiality. So how do you think with materiality important for an audit? And how do you fix your materiality for an audit? So in our audit opinion, do we say we validate 100%, or what is it? What is the audit opinion we issue? Sorry? What you have observed, yes. And we use the word based on materiality, right? So it is not that 100% of the transactions of the company are validated. You fix a materiality, your audit procedures are performed based on the materiality, and that is also called out in our audit opinion paragraph, right? To say that it is based on materiality and the audit to the extent of the audit procedures we have performed. So that is very important. So fixing the materiality is very critical for an audit. So what are the benchmarks which we can take based on turnover? Okay, and which all companies, I mean, which company you think an asset can be used, which company a revenue can be used? Is there a guidance? Let's say the company is making profit. It's a profit-making company. So what do you think would be an ideal benchmark for a profit-making company? Sorry? Revenue, okay. Profit, because they are recurring profits. So profit is one way you can look at. Revenue you can look at, it depends on who are the intended users of the financial statements. Say it's a listed entity, right? Then profit, because the shareholders are looking for dividend of the company. So the benchmark has to be the profit. In a private limited company, you can still look at the closely held private limited company, then you can look at revenue as a benchmark. Let's say it's a cost plus company. My revenue is cost plus markup of say 10%, 50%, which I bill to the group. Then what do you think could be a benchmark? Cost could be a benchmark. It is nothing but what the focus of the stakeholders, shareholders are going to be on. Now in the cost plus, where I had mentioned, the cost, if we are going to take revenue as a benchmark or as a profit as a benchmark, do you think it will be a right strategy? No, the focus here has to be on cost, because your revenue is just a markup on that and the profit is just a residue of the revenue and cost. So if they will have to, if an engagement team would need to perform audit procedures, the materiality has to be based on cost so that the audit is carried out in a more efficient and effective manner. Let's say it's a leasing company. Then what will be the ideal benchmark? Asset is something we can look at, right? Because it will be a heavy asset balance sheet. So then asset is one option which we can look at. And when you are fixing the materiality, of course the benchmark is fixed. And your rule of thumb will be, generally, what is the rule of thumb we take? Sorry? 0.5, okay. 5% of the profit. In case of a revenue, you will take 0.5, because 0.5 on a profit will be too low, right? Then you will end up validating more. And 5% is an average, and you can go up to 10%. It is on the professional judgment. The standard leaves the rule of thumb and the materiality benchmark to the professional judgment of the auditors. So we will have to see whatever benchmark we are considering, it is appropriate, and the rule of thumb which we use on the benchmark is appropriate. So that is very important. So once you fix the rule of thumb to say it is 5% of the profit you're going to take as a materiality, that becomes the overall materiality for the client. Now your audit will be based on the overall materiality, or you will have to look at some other materiality to validate on the samples. You will have to look at the performance materiality, where you will keep it slightly below your overall materiality. Maybe you will give it a 10% haircut or a 25% haircut based on your audit experience with that client, right? If you've been a recurring client, year on year you've been auditing on a client, and there have been no adjustments which has been posted, no audit adjustments, no errors, then you could look at a higher haircut. So you can have a higher materiality, so that your audit, you can focus on key areas and not spend more time on validation of more samples. But where you have issues in past, there has been control deficiencies in past, and where there have been adjustment entries which are being posted for the client on a recurring basis, then the haircut which you keep should not be at 10%, it should come down, so that you pick up more areas for validation and more samples for validation to ensure that the errors are not a recurring error in the current year. So that is a judgment which the auditor will have to take, and that's a very important judgment which the auditor will have to take. If we go wrong in fixing the materiality, then the entire audit downwards will be considered incorrect. So getting the materiality right is very, very important. So I think that's what it calls out. And once the materiality is set, do you think it has to be the same throughout the audit? The answer is no. Okay. So you will go back and revisit. Say when you started the audit, as I had mentioned, last year there has been no adjustment, so you've given a higher haircut, so you have a higher performance materiality. Now what happens when you're at the execution stage, you see that there are errors coming in, which is generally unusual. Then the question is whether you'll have to go back and revisit the materiality and bring the materiality threshold down, so that the risk is addressed. So these are the triggers which you will have to look at, and materiality is not that it's only happening at the planning stage. It needs to be looked out throughout, and then you will have to reassess the materiality even if it is required at the execution stage. That is very important. So I think this captures whatever we've discussed now. Planning and performing audits of financial statements. Users are very important. If the financial statement, if it's a private limited company with no borrowings, then the users are very limited, right? Then you can have a higher materiality and audit. But say the company has huge borrowings, though it's a private limited company, it could be closely held private, but the company has borrowings, then the users of the financial statements are the bankers as well, right? Then you might not have to, you cannot afford to have a higher materiality, which ideally you would want to have in a private limited company. So it also depends on the financial statements. Users also depend, they drive the materiality here. So that is also very important as to who the users of the financial statements are. So materiality will be on the professional judgment, and the performance materiality will be set below the OM, and it needs to be revisited during the course of audit if required. The audit team initially planned to determine materiality using PBT as benchmark. However, the company had incurred losses. Now whether to take that as a benchmark or you have to shift to revenue, which is an option we have, the audit team will have to assess and then revisit their benchmark. So that's very important. So if it's it cannot be a cost plus company, because if it's a cost plus company, they would have made profit. So cost is ruled out. Then maybe assets, if it's an asset heavy company, whether assets can be used as a benchmark. But you will also have to see, when you are taking a benchmark, that based on the materiality you have taken, right, the benchmark you have taken, initially you thought the company is making profit and you've taken a benchmark, but then that turns out to be a loss in the scenario. Then you will have to revisit. That's very important. It is not that at the planning stage I thought it was a profit and then I've taken profit as a benchmark and moved ahead. That is very important. So before you finalize the audit strategy, the materiality is important, because you will see which all areas, if there are very areas which are not material to the financial statements, whether you actually want to go back and audit that area or not, you will have to decide. So you will have to fix the overall materiality and the performance materiality before the audit strategy is finalized. That's an example where the auditor has established 25 lakhs of the overall materiality based on 5% of PBT, and performance materiality is set as 75%. So a haircut of 25% has been given for this. Management argued that rupees 20 lakh misstatement in loan classification was immaterial compared to the company's total assets of 200 crores. However, the auditor noted that the misclassification affected debt equity ratio disclosed to investors and lenders, potentially influencing their economic decisions. So this is an example where you've audited, you've identified issues or you've identified inaccuracies, right? Then next comes whether you will have to ask the management to post the entry, or you can live with it without posting the entry in the financial statements. In this case, management is saying that this is a classification. So management is saying, I'll just leave it with, I'm not going to change the loan classification. I will leave it because the number is not material. Now you will also have to disclose the debt equity ratio. Now the debt equity ratio will be skewed up, and you will never know if the bankers will also have a look into the financial statements, right? So in this case, then you will have to see, it is not only on the quantitative factor, it is also on the qualitative factor. You will have to look out to see how you will address this. So that is very important. It is just not the numbers, it is the qualitative factors also which will drive to say if this needs to be, if the adjustment needs to be posted by the client. If the client does not agree to post, then obviously you will have to call that out to those charged with governance, and if it is materially misstating, then you will have to see whether it is going to affect your audit opinion. That is very important. So this is a significant fluctuation during the audit period due to a product launch failure. So maybe you, in this case, whether you will have to revisit the materiality, the answer is yes. Say for example, you had taken profit as a benchmark and then you have done. Now that will undergo a change. Maybe revenue you will have to look out. The focus is going to be on revenue. So then maybe the revenue would be an ideal scenario. So you will have to look out and see if it calls for a change in materiality. So these are the key principles which we had mentioned, that materiality, how do you fix the materiality at the account balance level or at the financial statement level, and how you audit those numbers, and where you have small inaccuracies in each of the FSLI, you will have to look at whether it will have an aggregation risk, whether those put together will have an impact on the financial statements or on the profit numbers. So all that will have to be assessed when you are looking into the materiality. And materiality will drive your nature, timing and extent of the audit based on the values where your sampling and everything will depend on. So that's also important. So this is an example where you have a PBT of 100 crores. The auditor has used 5% as benchmark. So materiality for the, and as a whole would be 5 crores. Any misstatement below 5 crores is likely to not affect the users. So your performance materiality will be at 5 crores or less than 5 crores, because 5% is your benchmark. That becomes the overall materiality. Then you have to give a haircut and then keep your performance materiality and then validate. So that is very important. So that is what they mentioned, that they've kept 70% and 3.5 crores is where they are looking at. Anything above 3.5 would have an impact. 3.5 is the performance materiality, and anything over that you will have to look at. And revision of materiality, as I had mentioned, during the course of audit, if it requires, you will have to revisit the materiality. So what all documentation you will include in the those charged with governance and in the audit file? What was the initial materiality? If there is a change, why there is a change? How have you factored? how is it affecting the nature, timing and extent of audit. All that needs to be documented in the file, which is very important. So these are some of the benchmarks which the standard calls out. And when you're fixing the percentage to be applied on the benchmark, you will also have to look at the complexity, entity size, the users of the financial statements, volatility, how the other peers are using of the same company, right? The same industry, how they are using, what is the benchmark they are using. All of that can be a basis in which you can determine the materiality. I think with this we'll take a break, and then maybe after 15 minutes we'll connect back for the balance session. Thank you. So how many of you all have the experience of interacting with service organization, looking into their reports? Any experiences? No. So the service organization, obviously we know where the client has outsourced either certain process to a third party, where say for example your payroll processing is being done by a third party, or where the entire books of accounts could also be outsourced and it's with a third party. Now as an auditor, when we are doing the ISA 315 or SA 315 assessment, right? So this is also will be a key area to see who are using the service organization. Is the client using a service organization? If so, who is the third party service organization which the client is using? And as an auditor, we will have to assess their competency of handling the information. And number two is, we are the users of the, or we means the client is the user of the service organization, right? Then we become the users auditor. We are the users auditor here. Now, since either a particular process is being outsourced or the entire bookkeeping is outsourced, we will also have to assess as an auditor what are the controls, the process and the controls which the service organization itself has. That is very important. And you will see more of these service organizations kind of setup coming up with lot many GCCs, shared service centers coming up where the clients outsource their work. So this is very important. And considering that we are in a scenario where we issue controls opinion as well, now when a key process or any process for that matter is being outsourced, financial process has been outsourced to a service organization, as an auditor, like how you assess the design and operating effectiveness of controls in the client, the expectation is at the service organization level also there is a design effectiveness and operating effectiveness test which is being performed. Now that can be done, need not be that, because when you say a service organization, say for example Accenture, right? So they handle books of various companies. Now each auditor cannot go there and audit saying that I want to audit the process and controls, right? So that is not feasible also. So what they would do is that service organization can hire a third party who will be an auditor, who will audit their process and controls and provide a certificate based on, or report based on which the user entities auditor. Say for example, I am auditing company A. Now my process are outsourced to Accenture, and a third party is appointed by Accenture to audit their process controls, and they will give a report. Basis that report, which is a common report for all the clients which has been handled by Accenture, because they will be using only one process and controls. Now they will give a report, and as a user entities auditor, that is client A's auditor, I will get that report and I will look into if whatever I need from that report, to say if the ITGCs I'm looking at, whether the ITGCs are fine, the design of the process is fine, the controls are fine. So all of that I will have to look at and get a comfort over it. Now when you look at a service auditor's report, there are two types of audit reports which a service auditor can issue. One is called the type A report, where they will only look at the design of the control. They are not going to test the controls for you. They will only say in the report that we've looked into the process of the company and the controls are designed in the way they have to be designed. And say for example, whenever a purchase is done and invoice is being accounted, a three-way match has to be done, right? So that's the process or the design of the control which the service organization is having. Now, in a type A report, it will only cover that control is designed. Yes, the control is designed. Whether the individual, whoever is performing the control, whether he's operated the control, will not be covered as part of the type 1 report. It will be covered at the type 2 report. So in the type 2 report, it will have both the design and the operating effectiveness of the control. So we have to be very careful when we are relying on service auditor's report based on what is our scope and what we want from the audit report, whether we are able to get a comfort. Say we are going to issue a IFC opinion, right? Just a design alone will not be sufficient. Operating effectiveness is also important. Now we have to see if the service auditor's report contains both. But say there is no IFC opinion, it's a normal audit where IFC is not applicable, then maybe a type 1 itself is enough, because our standards on auditing SA 315 says you only have to do an understanding of the risk assessment process and understanding of the process and controls. Testing of controls, if we need, we need to ensure that that's part of the report. Otherwise, we can still do with type 1 report. So when we are getting the service auditor's report, as an auditor, third party auditor, we will have to look at the report and see whether it meets our requirement. That is very important. Any questions as far as the use of service organization and the type 1, type 2 report? Okay. So sorry sir, sample testing of? Yes, you can rely on the service auditor's report. As far as the process and controls are defined, provided the service auditor's report will also contain the nature, timing and extent of the procedures they have performed, where in the extent of testing they will say what is the count of samples. If all that is covered as part of the service auditor's report, or they will say we've ensured it meets the guidance note issued by the ICA or it meets the PCOB standards, it will call out. So then it is assumed that they have done that work. Then you can rely. You needn't have to test additional samples or test more samples for that particular area. For a control you needn't have to, but substantive you have to. Like how you perform your normal audit procedures for substantive, that you will have to. From a controls, if you are able to get a comfort from the service auditor's report, there is no additional procedures you have to do, but you will have to assess the report which is shared by them and then document in your file how comfortable you are to say the design and operating effect, because then the report has to be very detailed fashion from ITGCs to business process level, and the operating effectiveness, all of that will have to be factored in the service organization report. Yeah. No, SA 600 will be where it is a group and a component auditor. That's the difference. Here it is it's your audit. It is not a group and component, or the relationship is not a group and a component auditor. It is the auditor with the service organization, because the client has outsourced certain process with them or outsourced the entire bookkeeping with another auditor. That's the difference between the two. So the auditor's responsibility, as I had mentioned, you should look at the nature, timing and extent. So sufficient of the appropriate audit evidence whether the user entity uses. So that's very important in looking at the audit report. The auditor evaluates the control which is there in the service organization and assess the nature, timing, extent, and then standard permits the use of service auditor's report. So to answer the question, yes, the standard allows you, and you needn't have to perform any additional procedures provided you applied your judgment and you're comfortable with whatever report which is being issued. If you believe that you are not comfortable with the service auditor's report, or the NTE, whatever the service auditor has performed, you are not comfortable with, you are not aligned with, then you will have to perform your own procedures. So I had mentioned on the type 1 and type 2. The type 1 will provide only on the design of the control, and the type 2 will provide both design and operating effectiveness of the control. So you will assess the competency and independence of the service auditor and relying on the controls, and sufficient appropriate audit evidence so that you are able to issue the opinion. Else, if you are not comfortable, more samples, if the client is not willing to, then you will have to see how it is going to affect your audit opinion. And this becomes very important now because with the audit trail and backup coming in, right, when the entire set of the books and records are being maintained by a third party. Like say, my example I gave Accenture, where Accenture is maintaining the entire sets of books and records of the client. Then when you're getting the service auditor report, you should also ensure on the backup. So you will have two and the audit trail also, right? Now for this, engagement with the service auditor and the service organization at a very early stage is important, because you can't wait for the final report to come up and then you say that I thought the backup and the audit trail will be part of the audit of the service auditor's report, whereas that has not been factored. So you will have to engage upfront with the auditor of the service organization and tell them what are your requirements, so that when they carry out their procedures, they cover that, and in the opinion all that is factored. So that is very important, because this is where in most of the clients we see a gap where general process controls they would have covered. When it comes specific to daily backup and audit trail, we see a challenge where we are unable to rely. So that conversation has to happen upfront. So in this case, the company has outsourced payroll processing with a third party. Though the payroll transactions are not materially large, they are sensitive. Since the client, you could still live without testing payroll, but they are sensitive information. Then you will want to know if the controls and processes in safeguarding the information, because you also have to opine or take care of the safeguarding of the assets of the company, right, and the information of the company. So this also needs to be taken care of. So in that sense, then you might have to use the service organization and then perform. And when you are doing that, you will also have to see at the user entities level, that is at the client which you are auditing, whether the controls relating to the data which is going to the service auditor is also being factored. Say for payroll processing, though the entire processing payout could be done by the service organization, but the information has to go from the client, right? Because the onboarding will happen at the client place for the employees, the increments will happen here, whether the company has controls to see if the data has been correctly passed on to the service organization is very important. So that is also something which as an auditor we will have to look at, the controls which are there at the user entity level. That is also important. So this is on the payroll transaction where I had mentioned. So because it is sensitive information, we believe that a service organization report is required. So in this example, it is in AT services, it's a cloud solution provider. It supports financial data hosting for the client. One of its major client, Beta Limited, seeks assurance that the controls described by AT are accurately documented and have been properly designed. To facilitate client audits, AT engages a service audit to evaluate the system controls in place. So in this case, the requirement from the customer or the Beta Limited is only on the design, right? So they have said we need comfort on the design of the control. So in this case, then the service auditor will issue a type 1 report. But if you believe that you also need comfort on the operating effectiveness of the control, testing of the control, then you have to go for a type 2 report. So that communication has to happen. So based on the scope is where the service auditor also will issue the report. And the service report will not be addressed to the client. It is in the client means your client. It will be in general to the service organization. So your client is part of the service organization. So it's assumed it applies for your client as well. So the service auditor concludes in this report that AT's control systems are fairly described, because he's got a type 1 report where he also wanted comfort only on the design. So he is evaluated, he is comfortable, and in his file he will document, I have received the service auditor's report. We are comfortable with the procedures performed, because they will lay out the procedures, they will say whether they have identified any deficiencies. Based on that, we will conclude in our file to say we are fine with whatever we have received. So in this case, it is also not only on the design but also on the operating effectiveness. So you're talking about a billing data, one of the major clients, due to critical nature of the operating and regulatory expectation, O Limited requires assurance not only on the system description and control design but also on the operating effectiveness. So here you will have to go for a type 2 report where you will get both design and operating effectiveness, both you will get. During the audit of FinServ, the company outsourced its entire payroll function to a third party. The auditor identified that payroll processing errors could materially affect salary expenses, employee benefits, tax deductions recorded in the financial statements. So again here we are going for a SOC 1 type 2 report because you are going to all payroll processing inaccuracies and pension benefits tax reductions. So they are going for a type 2 report. And if there are any deficiencies identified in the service auditor's report, then you will have to factor that as part of your audit opinion to see if you are going to give a clean opinion or there is going to be certain qualifications based on the service auditor's report. So this is based on critical application backups which I had mentioned. So if you need a comfort on the backup and audit trail, then that also the scope needs to be agreed and ensure that that's also part of the audit report, the audit report which is being provided by the third party, and we are able to get a comfort out of it. So as I had mentioned, the identification of whether a service organization is being used by the client or not, you will identify as part of SA 315, and basis that you will assess the competency, what is the scope of work which is done by the service organization, then seek for the report. You will see whether it is going to be a type 1 report or type 2 report, has to be identified at the planning stage, because if you are going to come at the end of the audit and ask, it might not be possible for the service organization to issue, then you will have to see how you will have to issue the opinion. So then you will have to be clear on what your requirements are. So you will have to contact the service organization, visit the service organization to answer to your questions, sir, whether additional samples, whether you're comfortable with the report or not. You can even visit inquire. Inquiry can be done. It is only that if you are going to take more of their time and validate is where they will have a problem, because they have already hired a service auditor and they have done the required work. So inquiry is permitted, so you can go and inquire with the service organization. Yes, so it depends on how comfortable you are with the service auditor's report. Now the person, whoever is going to perform the design and operating effectiveness at the service organization level, will also be a professional, and we should in all means trust his professional judgments and application. And of course, if you believe as an auditor you are not comfortable, then definitely you can go ahead. There is no restriction to say that you cannot perform. If we believe that it is a very critical process and I would also want to perform certain procedures surrounding it or certain additional samples and the client's permitting it, you can go ahead and perform those procedures. There are no restrictions on that. Yeah.
Logical doubt. So we are discussing or trying to play on the service organization, like in other instances where we try to figure it out and bring it in the audit report. And this is a case where we don't, there is no guidance to give it in our audit.
As part of the company's risk assessment, right, you are taking onus on, in that sense you will, as part of your ISA 315, when you are assessing that you are going to use the work of the service organization, say for example your valuation, right, when you are using a value, you are getting a valuation done, a client is getting a valuation done by a third party, we do not call that out in the audit opinion, right. So he is an expert in that field, we have relied on his work and we have performed whatever procedures which we would have to do in order to get comfort over the valuation what is being provided there. The same way for the service organization as well, we have the person whoever is performing that. That's why I said the competency of the service auditor is very critical here. So you will have to assess whether the person whoever is performing that work is knowledgeable, is competent enough to perform that work, and in the work also in the service. That's why in the service auditor's report, the nature, timing and extent of work performed becomes critical to say what all systems they have covered. Say the service organization has SAP for one, and then they have another system through which the interface happens, whether that system has been scoped in. So in the service auditor's report, all that will have to be called out. And you should also inquire with the service organization and with the client to say and confirm that these are the systems and whether those systems have been scoped in. So it is not that a report is issued to us and then we rely on that report. We have to perform certain procedures, document to say how we are comfortable. Since we are performing those procedures on the service report which is being provided to us, we are not calling out in the audit report. In a consolidated financial statements, what happens is, as part of the, now with the ISA 600 being revised, you have, you send instructions to the auditor and you get that area audited, and you will also have that communication with the auditor to say whatever procedures they have performed is fine, but you are not reviewing his work papers. So in that sense, you will not take the responsibility of giving that. But here you can look into or question whether whatever procedures which are required to be performed can be done. So in that sense, here we do not issue we do not call it out in the report. And the other one, in the service organization report also, you'll have to see the period of coverage. That is very important, because all the MNCs, if you see, they will do a Jan to December. We will be in April to March. Then the coverage of 3 months, we might not end up relying on the service auditor's report. So that also becomes very critical, that the coverage of the service auditor's report is also very important. For the 3 months period, they give a bridge letter. But if we are issuing a controls opinion, right, it depends on the professional judgment to say whether we actually want to rely on the 3 months bridge, or you want the user entity to operate certain controls for us to get a comfort on what is being done. So that is very important. The coverage is also very important. So type 1 or type 2, we had just discussed, evaluate whether the description design, they call out whatever expectations are, is called out in the service auditor's report. And when we are doing the operating effectiveness, please ensure in the service auditor's report, either the guidance note they have factored, or the PCOB standards, because more or less the count of samples are the same, so that needs to be called out. Otherwise, then we will have to pick up more samples and get additional comfort too, because we are end of the day going to issue an IFC opinion as well. So we will have to be very careful whether whatever sample size, minimum sample size, whichever is required, is being covered by the service auditor. That needs to be done. And in a payroll processing, as I had mentioned, the user entities controls also control what is operated at the client level will also have to be looked at to see if they comprehend the controls which is operated by the service organization as well. So both has to be looked in together. So they are complementary to each other. And then the time period I had mentioned, and also whether the service auditors, all assertions. So all that has to be part of the report. So period coverage, scope, all systems scoped in, financial statement assertion level, whether they have covered, any deficiencies they've identified. If they've identified and remediated, then how have they remediated? Are we fine with the remediation process and the sampling, whatever the auditor has taken? Are we fine with that? So all of these will have to be looked into. And as part of your inquiry with the service organization and with the service auditor, you will have to inquire whether they had seen any fraud, any cyber attack, all of that will have to be asked. So those questions will need to be asked, and whether there have been any non-compliance. So all of that will have to be asked and factored as part of the audit procedure. So what is the way out if we are not comfortable, management is not willing to give access, or the third party organization is not willing to provide us access to their books of accounts, then accordingly we will have to factor that in our audit opinion. That becomes important. The next one is on the evaluation of misstatement identified during the audit, SA 450. So we saw how we've set the materiality, performance materiality is done. We have validated the samples, and of course, as part of our audit process, audit procedures we've performed, we've identified inaccuracies. It could be in the sampling which we've identified, or in the reconciliations we've done, or in the recomputation we've done. There are various misstatements which we've identified. Now, what do we do with that? First, ask if the client would post those entries, if they are material to post those entries. If they are material, the client will have to post that entry, otherwise it will have an impact on the audit opinion. Now, if the entries are not material, then we can get it as part of the management representation letter to say we've identified these inaccuracies, but these are not material to the financial statements based on the materiality we have set. Hence, we are fine with not posting the entries, but this needs to be communicated to those charged with governance. So that needs to be done. And why we need it in the management representation letter? Because management also agrees that there are inaccuracies, but because of materiality, I am not posting. So whatever differences we identify, that also needs to be agreed with the management. Now, when we are looking at deficiencies, it is not only that single inaccuracy you will look at, you will have to look at the aggregation also. How we are addressing that. Say, for example, in an inventory you are validating, and in an inventory at the time of reconciliations, there are differences between the subledger and GL reconciliation. And when you are looking at valuation also, there is a inaccuracy you've identified. Now, the question will be whether each you will take as separate inaccuracies and say they are not material, or you will have to aggregate. The answer is it has to be aggregated and it has to be seen. First, at the financial statement line item level, it has to be aggregated. Then you will also have to look at from the financial statements level. So say, for example, you've aggregated all the inaccuracies in inventory, and that is not material to be posted in the financial statements, but it impacts the profit. And there is an other error which you've identified in revenue. That will also have an impact on profit. Now, both put together, if this becomes material, then management has to post the entries, otherwise it will have an impact on the audit opinion. So we will have to be very careful when we dispose of whatever errors or which we have identified. They could be factual errors or they could be judgmental errors. Factual errors will be where, as part of vouching, we identify, reconciling items we identify. Judgmental errors is where management has given you a valuation, you are testing the valuation, the discount rate, whatever they've used. You feel you have to do a sensitivity and then see if the percentage, whatever they've used, 6%. So we believe it has to be 6.25%. Then you will do a sensitivity to say 0.25, what is the impact? That's a judgment, right? There is no right or wrong here because they're more or less closer to 6%. So that's a judgment, but we believe 6.25 is right. The number is not material. So you can take it to your summary of uncorrected statements and not ask the management to post the entry. So you will have to be very clear on all your inaccuracies or all your uncorrected numbers, whether they are factual or judgmental. That is very important. And also aggregation of those also you will have to look at. That's the brief description of the standard. So you will accumulate all identified misstatements except those clearly trivial. But here when you look at, you will have to say all these are only error, no fraud. There's no question of aggregation of any inaccuracies on account of fraud. So that leads into a separate discussion. You will have to investigate, find out whether it's only this, whether it's managed. This is only pertaining to errors we are discussing. So those kind of errors, any trivial ones, whether you will have to look at it, and whether this requires for a change in audit sampling. On accumulation, if the number becomes material, whether you will have to increase your samples based on the count of errors you have come across. So all this will have to be carried out. So he evaluates identified and uncorrected misstatement should ensure the financial statements are free from material misstatements. All uncorrected misstatements will have to be either corrected, or if not corrected, they will have to be immaterial to the financial statements. Else you will have to see whether it will have an impact on audit opinion and whether these are systemic issues, and your conclusions will have to be communicated to the management, get in your MRL and in the board or the audit committee presentation. So here you have an example where VN Technologies Limited, the audit team identified various issues across financial reporting. A junior team member raised a query regarding what type of errors or issues should be considered. So the engagement partner then chips in and he says that all errors will have to be considered, but then you will have to see at an aggregated level whether it becomes material, else we can leave it at that and move on with the representation. So that's something which they will have to look at. And when you are looking at errors, please look at factual errors, judgmental errors, any principal errors based on processing errors, or where you've used an inaccurate accounting estimate. Say for example, you believe that the useful life of the asset, the management believes is 5 years, but based on their past, we believe it has to be written off in 3 years or 4 years. Then there is an estimate there. So those kind of errors which come up, if it is not material, it needn't have to be posted. If it is material, then they will have to post, or it will have an audit opinion impact. So here there is an identified significant misstatement involving over invoicing in procurement contracts, suggesting possible fraud and collusion. Now the question is, the audit team planned to report the issue to top management. They were informed that a central investigating agency was already conducting an independent investigation and internal disclosure might compromise it. Despite this, the engagement partner was considering the direct team to formally document the findings in audit file and issue a memo to senior management. Now the standard clearly calls out where there are investigations which are being done by investigating agencies, then we might not pass on whatever our observations are to the management and ask them to post the entries, because the investigation is still on the same subject matter by a regulatory authority. So the standard itself says in those scenarios we needn't ask them to post those entries and see how it will affect our audit opinion and leave it at that. So that becomes important. Sorry, sir. Yeah, that we will anyways call out, because when maybe if the investigation is still not concluded, the stakeholders will have to know that such an investigation is happening. So maybe we will give an emphasis of matter paragraph where we might have to call out that the company is undergoing an investigation and refer back to the management note. And it also says that if you need to get a legal advice, please go and get an external legal advice to see how this has to be handled. That's also been called out. They were conducting an audit in a large retail company. During the audit, they found 2 significant misstatements. One is revenue was overstated and cost was also overstated. So management is saying they are 2 different line items. So I will not go ahead. It will not have an impact on profit, because both your revenue and cost is overstated by the same number. So they are saying profit, it will not have an impact. So they are not willing to post the entry. But we know that they are 2 different separate line items. So we might have to ask, because revenue is something which the stakeholders will look at, maybe the bankers will look at. So we might have to make them post the entry. And it will be a judgment call, because if it's going to be a private company closely held, then whether they will have to post that entry, it leaves it to the professional judgment of the person who's auditing the client. The audit team identified multiple misstatements, in this case in inventory valuation and revenue recognition. Individually these were below materiality threshold, collectively they were high. So anyways you will have to post it if it has a material misstatement to the financial statement, because everything goes back to not only that FSLA in the financial statement but overall financial statement. So you will have to look at all the inaccuracies which has happened and errors which have happened to see if it is going to be material to the financial statements. This is another example where unusually high number of misclassified expenses, whether you can admit that error if it will go back to the materiality threshold. I think we discussed this in depth on accumulation, communication, and whether we will have to ask the management to post the unaccounted entries, uncorrected entries. The next one is on SA 500 on audit evidence. Yeah, sorry. When you are taking both as one single FSLI, then it can be netted off to see, because from the profit perspective also what will happen is the net impact is going to be on the profits, right? So here the profit, one side you will have an overstatement where your valuation will go up, and then you will have understatement where there will be a reversal. So net impact on profit will be below your threshold, so you can still live with that. So SA 500 on the audit evidence, on the quality of audit evidence, whatever we get. Sometimes there could be evidences which we look at predominantly internally, which the management generates, which is held by the management. And of course, we look at third-party invoices, all of that. And there could be scenarios where we depend on valuation reports, right, where it is provided by an external third-party valuer. And how do we audit those numbers? What is the evidence? It is not that the valuation report is provided to us and we blindly rely on the valuation report. Whatever assumptions which are being used, including, say for example, the revenue growth, whether we will have to sit back and see, the valuer would have said it is fine, but as an auditor, how are we comfortable with the growth? Say for example, in the valuation they have factored every year they have done a 10% escalation for 5 years, and the terminal growth is also 10%. Whereas we know for a fact every year the client has done only 5%. Then we will have to challenge how they are comfortable with the 10%. I think this is where sometimes we miss to look into it, and the valuations are generally done on a higher end, and when there is an issue, then we get pulled up as a professional accountant to say that what are the procedures you have performed. Yes, he is a specialized person to do the valuation, but there were certain elements in the valuation which, as part of your normal audit procedure by inquiry and inspection of documents, you could have also done, right? I think that is where we'll have to be very careful to say that these are the procedures which I have performed based on the valuation which has been given on growth rates, on capex, on working capital changes. All of that we will have to look into it and see whether we are able to corroborate with the evidences which we have based on the past performance of the client, how often they meet the budget. All of that becomes very critical. So that is also some of the audit evidences other than the normal audit evidences which we look at to ensure that the audit is appropriately done. So it says you will have to rely on the audit, whatever evidences you're looking for, whether those are complete and accurate. And especially when you're testing reports, you're relying on controls, all of that, the underlying reports we will test to ensure the completeness and accuracy. So whatever evidences we are obtaining, whether they are fine. So that we will have to look at. And the standard says, how can you do it? You can do it through inspection, observation, inquiry. So these are some of the methods in which you can look at it. It also says that independent source is more reliable, right? You anyways have your external confirmations when you send out. So all of that are part of the audit evidences which you can collect. And it is not that always it has to be only external confirmations. You can look at other external evidences as well, where a third party invoice you're relying, a third party delivery challan you're in. Those are also good evidences which would give you a comfort to say you have obtained sufficient appropriate. When you say sufficient appropriate, it is not only on the volume of evidence but also the quality of audit evidence which we obtain. So that is also very important. So management expert, you will have to obviously look into the independence and competency to say that they're competent to perform that procedure. I think that is very important when you look for valuations and other third-party thing, to say whether he is competent to perform that valuation. Actuarial report, whatever we get, we have to challenge whatever assumptions and say they have used 10% attrition, whereas the client we've seen a 20-30% attrition. then how 10% is fine, right? All those we'll have to challenge, and all that have to be documented, saying that we've inquired all of those, this is the response which we've received, and how comfortable we are with. So all that is very important. So here the auditors attended the company's physical count at the main warehouse, and what is the safeguards you will say. So when an audit, you're doing an inventory count, obviously you look at the instructions, see how the inventory count is being performed, you'll observe the process, and then look at whether there are any count differences which have been identified. So that will be the evidence which you will look out for. So observation and corroborative procedures provided. And when you're doing an inventory or any count not at the balance sheet date, then you will have to ensure you roll forward or roll back to the balance sheet date to see if the inventory was physically available. So what are evidences you will have to see for that, you will have to perform those procedures. So this is a sales summary which is generated from an in-house software system. The report showed a significant increase in sales. So this is a new system. System is suddenly showing the sales is suddenly gone up. Now you will have to go back and see, test the system. Initially you would have thought you would not have scoped in the system, or if you've scoped in the system, you would not have relied on it. So now you will have to see what is the reason for sudden increase in sales. Maybe a new customer has come, so you have to look out all of those evidences, look into the contract, see all of that as evidences, because this is a material FSLI, and if there is a material change in the revenue, then you will have to look at those. And whatever you get, whatever you see, please document. I think that is very important, because from a regulatory perspective, they also look into the documentation. That is very critical. And I think here it is on the competency which we discussed. And the assumptions, valuations, please challenge the assumptions used by the valuer. That is very important. So this is on insufficient physical verification. There's another standard where we'll cover on specific procedures for inventory. So maybe I'll cover this as part of that. The reliance on external confirmation. So here it's a distributor. It has significant trade receivables. The auditor sent confirmation request to customer to verify outstanding balances. We will have to see if we have received the response. If we've not received the response for the confirmations, then we will have to perform alternate procedures like liquidation procedures, collections we will have to see. And when we receive the confirmations, whether it is from an authentic sources also, we will have to see that. Those are very important. So this is on the sufficiency and appropriateness. As I had mentioned, it's both the quantity and quality. It is just not the count of samples which you get, but also the quality of evidence. Say for example is an sales invoice. It's an SAP generated invoice, which will be an internal invoice, right? So there's no point validating just the 200 or 300 invoices. It is linking it back to other evidences for the occurrence of the transaction. Say for example, you're looking at a delivery challan. That's an external evidence which you can corroborate with the sales invoice which you have seen. So it is just not volume of transactions, it is also the quality which we will have to look at. So competency, we spoke about experts, use of experts. And then based on the evidence you have obtained, it can be both in test of controls and in substantive procedures both. These are on specific consideration for selected items. So here we will look at specific items are inventory, litigations and claims, and segment information. So inventory is critical here, because you will have inventory which are at the client premises, which are at the third party, then the coverage, and if the client is a retail, right, they will have inventory across various locations and regions. Then how do you scope what all areas, because we cannot do 100%. The standard also does not require us to do a 100% count. It is, we'll have to ensure that a process is followed by the management, and we have to observe the process. And at the part of observation, there are few samples which we can pick and we can count the inventory. Now we will have to see based on the value of the inventory at each location or warehouse, which are the ones which we are going to scope and we are going to personally visit. and which we are going to rely on confirmation provided by the, if it's a third party, confirmation provided by the third party. So that it lays down to say what all procedures you will have to perform, and where it is easily countable, say it's in a box or it's in a sack, then it is easily countable, that inventory. Whereas, say for example, you're doing a fertilizer, right, where you will see heap of fertilizer lying there, or sugar, then you will have a expert also who will accompany, who has to accompany, right, because they will measure the length, breadth and height of the fertilizer which is in piles or in a sugar, and then they will have to factor certain assumptions. So you will have to ensure that all that has been looked at, or when you do the physical verification, you also mark the same points which the valuer is looking at, because you will have to go along with them and do, right, where management expert will be involved, and where it requires an auditor's expert, which we believe we need to use our experts also, then the auditors also will have to bring in their experts. As in the example I gave on where the inventory is in piles, right, in a heap you will have, and the measurements, whatever the management expert is using, when you can observe and make the same measurements to whatever they have done. But there are certain other factors also which the management expert will use. Say for example, they use a density. Now we are not technically qualified to say whether the density whatever he has used is right or wrong. If we are able to get through an external information through an external source to say if the density whatever he's used is appropriate, then that is fine. Or we believe the inventory is very material and we need to use an auditor's expert, then we can appoint our experts, especially for this kind of wherever a density is involved, whether the density used by the management expert is appropriate. So those are certain procedures which we will have to perform. Any questions on inventory, on procedures? And when there are various regions where the inventory is laid, ensure that the instructions have been sent out to those, and there are common instructions or common processes followed for inventory. That is very important. The next one is on the litigation and claims. Of course, any litigations, I think confirmations we will have to circulate if they are material to the financial statements, and any legal cases we send out confirmations, and whatever enquiry we've done with the management or the in-house legal team, whether that corroborates with the confirmation which is provided by the external counsel, whoever is handling the legal cases, are important. So we will have to get that. And the other important area which when we are doing litigations you will also have to see is the legal expenses and professional expenses, right? When you're scrutinizing those expenses, you will have to inquire. So the team members will have to be informed that when you're looking at a legal expense, you will have to understand for what purpose that expense, legal expense has been incurred, so that you can corroborate to see if there's a pending litigation which the client has not disclosed to you, right? So the proper coaching and direction is also required even in a validation of normal expenses. So that becomes very important. And then the segment information. So here the segment information you will look at from a management's perspective, how they are looking at their segment, whether they're looking wholesale, retail as separate segments. Then you will also have to accordingly factor that for the segment information, and how they are capturing the information at that segment level. And there could be certain unallocated assets also which will be there, which you will have to call out for. So that is also very important. So these are some of the external search which the standard in the standards they've laid out to say that you can look into these filings and records. So as I had told, auditor attends the physical count, because in CARO we will have to report on the inventory count, observe how we've observed, whether the management has done inventory count at regular intervals, are we comfortable with the size of the company, are we comfortable? So all that we will have to call out on CARO. So we will have to ensure that appropriately this is being done and it is reflected in the work papers. So you can get confirmation for third party also, but as part of professional skepticism, maybe once in 2 years or 3 years you will also have to visit the third party place to ensure that actually there's a third party and there's an inventory lying with the third party. That is also equally important. And inventory, when you're not doing it 31st of March or 31st of December, which is your reporting date, you've done it say 5th of April, then you roll back to see whether the inventory existed as of 31st of March. So all those procedures you will have to perform for the intervening period. So this is an example where the auditor was wondering whether they should attend the year-end stock count to observe management's counting procedures and test checks. The answer is yes, unless you have observed any of the cycle counts which are being done by the management. Else you will have to participate in the year-end count because you will have to report in Caro, right, whether you've observed. So that is important. The company is hazardous. So this is a situation where because of the restriction you are not able to visit. Then because this is the inventory is stored in a restricted area where you do not have physical access, you cannot access there. Then the question is whether any alternate procedures can be performed. If we are unable to perform any alternate procedures and the inventory is material, then you might have to call out in the audit opinion. And of course in Caro also. This is on a major lawsuit where the management and the auditor has a differing view. You can go for a third party legal opinion to disclose the litigation. Of course, external confirmations is also required to get the management's view also. This is on multiple inventory at multiple locations where you will issue instructions, follow that, ensure management is following and every region has followed the instructions which is being provided and whether the instruction has gone to all the locations. Say for example, they have not sent out to one location, right? Then we are not sure how they would have done or whether they have done. So then we will have to ensure that the instructions have been appropriately circulated to all. So this is on several bank accounts and directly we are not able to get the confirmation. So whether you will have to qualify no, alternate procedures can be done. Only after performing alternate procedures also you are not comfortable with the bank balance or anything, and then you might have to look at whether it will have an impact on the audit opinion. This is more what we have just discussed on the physical count, use of experts, all of that, and his competency also will have to be assessed and documented. This is on litigations, and wherever you have relied on management's experts or you have relied on our experts, that have to be communicated to those charged with governance. So that is very important. So segment we had mentioned. And when you are doing the segment information, ensure that the whatever management looks at that segment level, you've also looked at, and what is the process and controls they have in place to capture the information at that segment level. So that is very important, and you will also maybe have to test some samples to see if it has been appropriately classified, and you will also have to compare with what has happened in the prior year. Is there a deviation? And if there is a deviation, if there is a change in the way segment reporting is being done, then we will have to inquire and understand why there's a change and factor it as part of our audit procedures. And this is on the external confirmations. So I think everyone would be very clear on how we have to circulate the external confirmations, ensure that it is being sent out on from the auditor's end, the external confirmations, and when you get a response, if the response is being received from the authentic source. And these days we see that we send out confirmations through emails, right? So in that sense, then you'll also have to look at the domain to see if wherever you're receiving the confirmations, whether they are appropriate. And the receiver also, we will have to see whether they are authentic and they have been provided by the client, and get it vetted by the client to say these are the set of people to whom we will have to send and they are the right person to whom we are sending. This is very, very important, and especially from bank confirmations and accounts receivable confirmations, I think this is very important. So this is the responsibility for circulating is with the auditor, providing information for circulation is with the client, and of course the authenticity of the confirmation which you have received, we will have to be very careful when we are receiving it. And when it's through an email, either a call procedure, you can call back and ask whether they were the person who sent the confirmation. The domain check is one way of looking at it, whether the email ID is an authentic email ID. Those are very important. So apart from your normal bank confirmations and accounts receivable confirmations, say for example there is a major contract which the company has entered into, and we believe that certain clauses of the contract will have a material impact on the financial statements. Then there have been scenarios where we can even circulate calling out the major clauses to say if this is something which has been agreed as part of the agreement, whether they have entered into any side letters. So all of those kind of confirmations can also be sent. And when we send a confirmation, whether we have to send a negative confirmation or a positive confirmation, which is preferred. When I say a negative confirmation, if we don't confirm by say 10th of the next month, we assume the balance is a fine. Always a positive. Especially when you're doing an accounts receivable and a bank confirmation, it is always a positive confirmation, because we generally avoid sending out negative confirmations. So a preferable approach is always a positive confirmation. And if you don't get the confirmation, there's no response, perform alternate procedures. If a bank, look into the bank statements. If it's a accounts receivable, liquidation procedures, legal confirmation, in-house inquiry with the legal team, and looking into the orders. All of that could be a way. If we are not comfortable, then you'll have to factor it in the audit opinion. This is on the negative confirmations, which we said we should avoid sending negative confirmations. We look at sending positive confirmations and where we need to get the response. So in the second case, the auditor has sent a positive confirmation, and where he has not received the response, he has performed alternate procedures. So this was something which we said it's confidential business relationships. So the client is saying we will not allow you to circulate confirmations. Now we can perform other alternate procedures. Few could be that you can speak to the customer, understand what kind of agreement they have entered into, what are the specific clauses, and document it in our file. The senior team member of the audit team can be involved in the process so that the confidentiality is maintained. And if we believe that, in spite of asking that we would want to at the higher level, even the partner is involved and then the client still refuses to permit, then we will have to see whether we will have to factor it as a scope restriction in our audit report. That is very important, because we've said it is a confidential business transaction and hence it could have an impact on the operations and the revenue of the company. The order identified a significant balance due from a major customer. So for the existence, they've sent a direct confirmation, no reply. You're looking at alternate procedures. So follow-up request, get the confirmation, and where you've not received the confirmation and you have circulated confirmation and you've not received the response, please communicate that to those charged with governance. This is an important aspect of it. Reliability, we said, how you can ensure reliability through get a client confirmation that it's a reliable source. You can also do your own search to see if it's a reliable address you have sent to. Callback procedures, all are some of the procedures which you can perform. So the last one is that inability does not mean you will qualify. Other alternate procedures you will have to see. Even after that you don't get a comfort is where you will go for a modification in the audit report. I think that's all I had. Thank you.
Thank you so much, ma'am, for this wonderful session, the insightful session. I hope you all have learnt from the session. So with this, we'll be closing the session today, and we'll be meeting again for a continuation of this program, 10 a.m. Thank you.